has taken the markets on the higher side. Interestingly, it also is about ETFs in the markets, especially for the month of July, where we have seen further inflows coming in for many of these cryptos. When you look at Bitcoin ETFs, well, $5.5 billion is what you saw as major inflows here. Even the Ether ETF has managed to garner $2.9 billion of inflows in the month of July alone. Now, going forward, the street does believe that you could be looking at further gains into the market because the buying in institutions is just about started, not just in US, but major Western world as well. If you look at the last 1 month, the month of July, that is, we've seen Bitcoin prices gain up by 11%, but the altcoins really have surged. So Ether is up 57% for the month of July. Cardano is up 47%, Solana up 26%. So it has been very, very strong gains for the month of July, with an expectation that you could be looking at higher highs for the rest of this year.
Manisha, thank you for that update. Well, it does look like all that glitters right now is crypto. $4 trillion now of market cap for the entire crypto market. Take a short break. But just as we do that, a small programming note for our viewers. As the workplace transforms, so must leadership. Now, in the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. You can catch this live on the 29th of July starting 5:30 p.m. only on CNBC TV18, CNBC-TV18.com and our YouTube channel.
Welcome back. You're watching Business Lunch on CNBC-TV18. Well, now on to the latest in the India-US trade front. Sources are suggesting that there has been no breakthrough in trade talks between the two nations ahead of the August 1st deadline. My colleague Parikshit Rutra is joining us with the details on this. Parikshit?
Well, yes, no breakthrough in talks yet, and we're just a few hours away from the 1st of August deadline. In fact, we're told that since the 18th of July, there has been no progress in talks, and they seem to be stuck on certain issues. One, Donald Trump wants to impose a 20% tariff on India, and he wants zero tariff in return. That is not possible. India would want to impose reciprocal, equal tariffs on the United States. Having said that, he wants deals on the likes of Indonesia, Vietnam, Japan. Remember, Japan has offered, apart from the trade deal, to invest $550 billion in the United States. Indonesia, too, has promised to buy 50 Boeing jets. They've promised to increase energy purchases to the tune of $15 billion, $4.5 billion worth of agricultural products. So these are the kind of major big-ticket investments and commitments that the US and Donald Trump are seeking from India. There doesn't seem to be any headway yet, but at the same time, the Indian government is not ruling out any interim deal over the next 24 to 48 hours. But it looks very, very difficult right now. Options are being considered. In case reciprocal tariffs come into effect on India, that is 26% plus a 10% BRICS tariff in case Trump decides to go ahead with that as well. India could also impose an equal reciprocal tariff on the US after the 1st of August. Also, what we will see continuing simultaneously is that trade talks for a larger BTA by fall, those will continue. There is a US negotiating team which is coming to India in the month of August, so they will discuss a larger BTA. But for the moment, any kind of breakthrough or progress or deal, interim deal, before the 1st of August looks unlikely.
Well, it does, and that uncertainty seems to be showing up on the markets as well. Now we're slipping below that 24,700 mark on the index at the lowest point of the day, 140 points lower, adding on to the drop that we had seen on Friday's trading session as well. Numbers from TTK Prestige, a 36% drop in its net profit. We'll get to that in just a bit. But in a major breakthrough earlier in the day, the European Union and the US have clinched a hard-fought tariff deal. Under the agreement, the European Union will face a 15% tariff on most of its exports to the US, including automobiles. Now, the compromise averts a full-blown trade war that experts warn could have delivered a hammer blow to the global economy. In what is the biggest trade deal ever, the European Union will buy $750 billion worth of US energy products and invest an additional $600 billion in the US. It is also expected to purchase hundreds of billions worth of military equipment from the US. The number was not specified by the US president. Let us in fact now listen in to the moment the deal was announced.
We have good news. We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries, because as you know, Ursula represents a lot of countries, not one country. It's not easy for you. It's because a lot of very different countries, great countries, but some are strong with cars, some are strong with agriculture. Some are strong with both, right?
Well, and as the August 1st tariff deadline looms, the US and Chinese officials will meet again to discuss their trade framework in Sweden's capital, Stockholm, today. China's vice premier and his team will meet with the US delegation led by Treasury Secretary Scott Bessent. Some political watchers say that the two sides could be working on an extension of their trade truce, which is set to expire on August 12th.
We'll take a short break for now. More news and updates continue on the other side. Stay tuned. Welcome back. Now, both Lok Sabha and Rajya Sabha were adjourned for the day after uproar by opposition MPs in both houses. In the Lok Sabha, Speaker Om Birla hit out at the opposition for not letting the question hour take place. The Speaker had adjourned the House till 12 noon with resumption scheduled for 1 p.m. The Operation Sindoor debate was to take centre stage during the proceedings today, with the opposition demanding answers from the government over India's 7th May to the 10th of May operation against Pakistan following the Pahalgam terror attack. The opposition also looks to corner the government over the 22nd of April terror attack in Pahalgam, in which 26 civilians fell victim.
Meanwhile, in some tragic news, 2 people were killed and 32 injured in a stampede at a temple in Barabanki district of Uttar Pradesh after a live electric wire broken by monkeys fell onto a tin shed. The incident took place while devotees had gathered at the temple during the holy month of Shravan, dedicated to the Hindu god Shiva.
And with that, we call time on this edition of Business Lunch. We leave you with the index at the lowest point of the day. From Amakshi and me, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. It's a Monday afternoon which is seeing a 200-point fall from the highs of the day. Midcaps are underperforming and we'll discuss more on the markets, but it is looking like a day for the bears so far.
day for the bears so far, and especially the BFSI space. Earnings across the board, especially for banks, have been quite a bit of a miss. Asset quality, even for NBFCs, has been quite muted. Credit cost worries, all of that is taking the entire BFSI pack lower. But we have a lot lined up on the show, so let's start off with the top headlines. Stocks slipped to the day's low on mixed cues from earnings and on the global trade front. Real estate, private banks and metal stocks drag. Midcap index underperforms.
Optimism around book expansion of 40% boost Poonawalla FinCorp after company reports its Q1 earnings. Management maintains their AUM growth guidance of 35 to 40%.
Shares of Acme Solar zoom in trade on the back of its Q1 numbers. Revenue increases 65% from a year ago. Profit also after tax also surges, aided by higher other income. The stock is up more than 8% in the session.
Zentech under pressure despite a good Q1 as profit halves as compared to last year. Management says they expect significant orders in FY27 from the United States.
Car trade tech sees a sharp recovery after a good performance in Q1. Net profit nearly doubles while margin also sees a sharp expansion. Stock up 6% from March 2023 lows.
All right, those are the top headlines, but the biggest headline is that sharp market fall that we have seen in the last couple of hours. It's a 200-point downfall from the highs. Nifty is at the day's low, and that downfall actually continues. It has been that one-way fall on the Nifty currently, and as Vivek was mentioning, it is led by these BFSI names. So private banking index, that should come up for you on the screen. 1.6% gone there. Nifty Bank is down 500 points, almost 500 points right now, and that's courtesy what we've seen in Kotak Mahindra Bank as well. The NIM pressure has been higher than what the street was working with. Across the board, there's a big cut. Be it the Midcap index, which is down 0.9%, the advanced decline ratio in favor of declines currently. Most of them are earnings reactions which have come by as well. So any miss on the earnings, the markets are punishing them. And look at those lines. So it was converging at a point in time, and now there's a big gap between the two, more in favor of the declines. And that's what we're going to discuss in the show as well. A lot of mid-caps which are reacting to earnings and news flow.
That's right. What's actually also contributed to the fall today has been some of the interest rate sensitive. So the realty pack, and especially in the last hour, a lot of the realty names have seen a significant cut in the session. Names like Oberoi Realty, Goddess Properties, all of these names, even a DLF for that matter, trading near the day's lowest point. But all of these names and a whole host of other stocks is what Hormaz has on its radar. This is our special segment, Midcap Movers. Hormaz is standing by the wall to take us through the midcaps that are moving around in the session.
If you're a bull, you may want to look away from the screen today. It does not paint a pretty picture whatsoever. As Sonal was just highlighting, any miss on the earnings is getting hammered and how. But we'll take a look at some of the positives first up. It's the earnings reactions that are on the positive side, stocks that are bucking the trend, if you could call it that. Car trade tech earnings came out today, 10% higher on that stock. Acme Solar and Sterlite Tech numbers reported over the weekend, both seeing healthy gains of around 7 to 8% in today's session. There are plenty of negative earnings reactions. You'll find out some of them. Paras Defense came out with numbers on Friday and it's down 10% today. It was down 3% on Friday. CDSL, after that initial recovery, has now slumped to the lows of the day as well. And Home First Finance too has taken a 6% knock in today's session. Real estate, as Vivek just highlighted, is a stock that is an index that remains under pressure, is a sector, is the top sectoral loser today. All of the constituents of the index trading with losses of anywhere between 3 to 5%. Some of the stocks that are doing well on the volumes front though, and look at Sudarshan Chemicals. While the index is at the lows of the day, Sudarshan Chemicals is at the highs of the day, 15% higher. It's a 52-week high for the stock. And Laurus Labs too, and the 900 rupees testing those levels today, 6.5% higher on that stock as well. And Aadhar Housing Finance did well initially, but has since given up some of those gains, still holding on to a 4% advance. And lastly, stocks that are at a 52-week high aside of Laurus and Sudarshan, take a look at Sarda Cropchem. Numbers came out Friday. The stock was up almost 19-20%. Sirma SGS and Manorama Industries too doing very well for itself in today's session. A 52-week high for that stock as well. Back to you guys.
All right, makes sense. Thank you so much for joining us, Hormuz, with that list. It's a good time to get a technical check on the markets. Sneha Seth from Angel One is joining us for just that. Sneha, a sharp fall from the highs. What is the market factoring in? What are the technical charts suggesting now? Do you think we'll break even these levels and see a lower level?
Yes, very much likely because if you see last three sessions fall, we have seen call writers shifting lower. In fact, today we are even seeing fresh writing coming in 24,800, 24,700 call strikes. At the same time, if we look at the daily chart, I believe there is one support zone placed around 24,650. But once we looking at the overall chart structure, it looks very much likely that we can slide below that and head towards 24 500 450 zone is very much possible over here. Looking at the banking index, which was holding on to the gains, it has also breached the rising trend line support zone. So looking at the overall chart structure, I think market may continue to slide a little down, at least towards 24 500 24 450 is the level to watch.
Thank you so much, Sneha. Sneha, so you see further downside in this context. What are your top picks for the day? Any buy or sell calls for our viewers?
So one call which would be a buy, that would be Cipla. If you look at the chart structure, this counter has managed to surpass the one trend line resistance which was placed around say 1550 1540 zone. So I believe looking at the overall chart structure and last two sessions volume based buying what we have seen, I believe this counter is heading above 1600 levels. So it's a buy for me. The target would be around 1620 and the stop loss can be maintained around 1527. Apart from this, the counter, which is a sell, that is Industrial Bank. If you look at the chart structure for this counter, it was consolidating since quite some time. The counter has a resistance placed around 89 EMA, and this from there itself we are seeing fresh selling pressure coming in. So this counter is a sell with a strict stop loss of around 827 would be the SL, and the target expected will be around 780.
Thank you, Sneha, for joining in and telling us your individual technical picks. By the way, there's a further slide in the markets. We usually talk about the mid-cap movers, but if we take a look at what's happening in the Nifty currently, we have a couple of these big names at the day's low. There's Axis Bank, which is sliding. We have Coal India. Tech Mahindra is at the day's low as well. There's Nestle, Tata Steel. All these stocks are leading to the fall that we are seeing on the Nifty as well. Overall, it is definitely Kotak Mahindra Bank, which is the biggest loser today, followed by Bajaj Fin. Since the time Bajaj Finance's numbers have come out and they have spoken about weakness, that stock continues to be on our radar. From the broader markets, Tanla Platforms, that should come up for you. That stock is down around 4.5%, reported numbers a while back, and they reported numbers basically, and it has been a slide on that one as well. Revenue grew 1.6% on a sequential basis, 3.8% on a YY basis. So that stock on our radar. JK Paper as well as lower in trade reports numbers today. So that stock as well in our focus. RPG Life reported numbers of the weekend. That stock also is at the day's low. So a lot of names actually which are seeing that sudden slide which has come by, and Nifty too is seeing a fall from the highs as we speak. But a small programming note for our viewers as we slip into a short break. As the workplace transforms, so must leadership in the Bengaluru edition of Future Female Forward, which is season 3. India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29, 5:30 p.m. onwards, only on CNBC TV 18, CNBC-TV18.com and YouTube.
Welcome back to Midcap Radar. Well, the sell-off has intensified, especially as far as the broader end of the markets are concerned. Now the NBFCs too are falling in tandem. Some of the names like REC, PFCs, the power sector lenders, those are the names now under significant pressure. But one stock from the broader end of the market, especially in the NBFC space, is Poonawalla Fincorp. This particular stock continues to trade with marginal gains in today's trading session. This was after their Q1 numbers. Gaurav joins in with the details of this particular numbers.
Well, yes, when we talk about Poonawalla Fincorp, the one thing which is actually keeping the stock in focus is the growth guidance. Now, what has happened is that EUM growth has been at around 53% on a year-on-year basis. Now, remember, company had given a guidance and they are saying that they can actually overachieve the guidance. So let's understand the numbers first. Net interest income increased almost by 13% on a year-on-year basis. When it comes to the operating profit, we saw a decline of around 24%. But another trigger here is that the credit cost. Now the credit cost has come down to 2.6% on a sequential basis versus what it was at around 3.1%. That is giving some kind of confidence in terms of the asset quality of the business. When we look at profit, now it has declined almost by 78% on a year-on-year basis. But what remains positive is that in this quarter, AUM growth was at around 53% and it also translates into 16% growth on a sequential basis. Now what company has said is that they are maintaining their guidance of 35 to 40%, but at the same time they also indicated that they hope to exceed the target because of the new product line which is gaining good traction. So that is something which is keeping the stock afloat. As a result, when we talk about the stock, even as of now, the stock is up more than 3% today.
Okay, more than up 3%. So basically, whenever and wherever there is some positive indication, market is rewarding that with some returns on the stock as well. CDSL, on the other hand, is under pressure after Q1 numbers. Revenues below street expectations. Wamakshi is joining us to tell us more.
Well, Sonal, the numbers, when you look at the revenue, that saw an uptick of almost 15% sequentially. This is, recovery as far as the previous quarter is concerned. In fact, in the previous quarter, we did see the revenues dip. The total operating expenses, though, grew at a slower pace as compared to that in the revenues, and resultantly, the EBITDA margin expanded by almost 170 basis points, pushing the EBITDA higher by almost 19% on a quarter-on-quarter basis. The net profit, though, grew only by 2% quarter-on-quarter, and that is because the effective tax rate for the company was much higher, resulting in a miss as far as the net profit is concerned, which is why the stock is down and out in trade today. Other than that, when you look at the segment-wise performance, the depository activity was quite robust. That segment saw an uptick of almost 22%. Remember, this is the core business activity of CDSL, and that has been doing quite well for the company. On the flip side, what did not do well is data entry and storage. That segment was down almost 13%. Repository, which is not such a great contributor, saw an uptick of almost 23%. As far as segment-wise margins are concerned, depository activity margins actually improved this time around to 444 basis points, and data entry and storage margins contracted very sharply by 1,208 basis points. So largely, when we look at the numbers for CDSL, the core business is doing well, but it's a miss as far as the net profit is concerned, mainly on account of the taxes, and resultantly the stock is taking a knock in today's trading session.
Absolutely right, Wamakshi. Thank you so much for joining us. Also remember, CDSL has rallied quite significantly from its recent lows, and that's another reason why we're probably seeing a bit of profit booking today. But Gaurav is still with us. Gaurav, Aadhar Housing also delivered their Q1 results, and along with that also technical development, especially as far as the ownership is concerned. Tell us more.
Well, yes, when it comes to Aadhar Housing and the numbers were fairly strong. Profit increase almost by 19%. In fact, we also saw AUM growth of around 22% on a year-on-year basis with a strong disbursement growth of around 32%. Apart from that, what remains also positive is that the credit cost, although it has inched up, it is again in line with what the street is expecting. And now management has also continued with their guidance of around 20 to 22% growth in AUM, and at the same time 18 to 20% growth in terms of disbursements. But what is another trigger here is that the change in hands in terms of the ownership. Now let's not forget that Blackstone is a PE firm who owns around 75% stake in the company right now. What is happening is that there is a block deal, there is an open offer from Blackstone. This transaction can be taken as a change in hand because what is happening is one fund of Blackstone is going to acquire around 64% stake from the current promoter fund, which is the BCP Topco V7 PTE. Now what is going to happen is that let's not forget that there was an overhang that there will be some kind of selling from the PE firm, because that is how it works. But given that the PE firm is actually acquiring the stock, once again, it gives some kind of confidence to the investors that, you know, the overhang is not going to be there, at least in the near term. And it also shows some kind of confidence that the PE firm has on the business. As a result, when we talk about stock performance, it is up more than 4%, definitely on the back of the good numbers, as well as this new development which is happening in the ownership as well.
Okay, all right. Thank you so much, Gaurav, for joining us with those details. But a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of the CNBC TV18 Access program, a premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back to Midcap Radar. Well, a couple of stocks that are buzzing, especially as far as the broader end of the markets are concerned. The top gainer on the NSE 500 is Acme Solar. Now, this renewable energy company delivered its Q1 results over the weekend. A strong set, very strong execution. Revenues high by almost 65% for the company in this particular quarter. EBITDA high by 62%. EBITDA margins, despite the higher base, largely steady, and profitability aided by much higher other income this time around has come in at over 130 crore rupees. Now, what essentially transpired is that, especially when you're looking at the commissioning of projects, it's gone ahead and commissioned close to 350 megawatts of projects, including its maiden 50 megawatt wind project in Gujarat. Along with that, operational portfolio now stands at close to 2.9 gigawatt, and the company has signed PPAs for almost 55% of the under construction capacity, thereby improving the EBITDA visibility for the under construction capacity. The Street clearly likes that particular stock doing very well in the session today. But one stock that's not doing so well is SBI Cards. Gaurav joins in with the details of that particular name.
Well, yes, when we talk about SBI Cards, credit cost is something which is causing the pain once again in the stock. So first, let's look at the numbers. Revenue increased almost by 12%. We saw a bit of a decline in profitability of around 7%. In fact, when we look at net interest margins, we saw an increase of around 30 basis points on a year-on-year basis. But what remains negative is that the credit cost. Now, it has reached to 9.6%, which is a 16-quarter high number. In fact, this is not just it. Now, management is also quoting that the credit cost is likely to remain somewhere in the range of 9 to 9.6%. So definitely we will see this number elevated even going ahead, and they are actually attributing this elevation because of the change in the assumption of the ECL model. And at the same time, let's also not forget that in Q3 FY25, when SBI Cards reported 9.4% credit cost, at that time management had indicated that they have reached the peak, but now we are seeing a new peak from the company. Other than that, what is happening is that the growth guidance has been cut down to 10 to 12% versus what it was at 12 to 14%. Let's not forget that in this quarter, we have already seen the growth slowing down to around just 7% on a year-on-year basis. And from here on, management, although expects growth to pick up, they have actually cut down the growth target. Now, going ahead, there is another trigger for the stock, which is the cost of funds, because now cost of fund is likely to decline almost by 25 to 30 basis points as per management because of the repo rate cut. But definitely at this moment, rising credit cost is something which is not taken in a positive way by the market. And as we speak, the stock is down more than 5% today.
Okay, all right. Take that point, Gaurav. Thank you so much for joining in. So those are some stocks which are on our radar today. But with that, it's a wrap on this edition of Midcap Radar. Stay tuned. Up next is CNBC-TV18's brand new show, Finding Alpha. Our expert will delve into the top NBFC stocks to track. Don't miss this critical analysis as we navigate the current financial landscape with our viewers.
Well, hello and welcome to Finding Alpha, the show where we zoom out to understand the macro and then deep dive into the micro. All of this to sharpen your stock selection process. Well, today we'll be focusing on a very, very crucial theme. Who stands to gain amid the rate cuts and asset quality concerns? With the RBI shifting to a pro-growth stance and introducing a series of rate cuts, albeit modest, investors are weighing this against tepid credit growth and some signs of emerging stress in asset quality. Well, to unpack this, we're now joined by Digant Harya, founder of Green Edge Wealth, a firm that builds tailored stock and high-yield bond yield portfolios. Digant, by the way, has been tracking India's banking and NBFC space for over 16 years and brings a sharp lens to what matters and what doesn't in this dynamic sector. Well, Digant, thanks a lot for coming down to the studio. And we're looking forward to learning more about, the financial companies, NBFCs and some HFCs as well. How are you feeling about the sectors right now?
Thanks, Nigel. Pleasure to be here. Pleasure to be on the first show of, the first episode of this new series. So yeah, I think, banks, NBFCs, it's a very large sector. So always there's interest. And the reason for a higher, a higher scrutiny for this sector now for investors is, the RBI started reducing the regulations and they have cut the rates. Yeah. And there's a finance minister who said that NBFCs should not think of themselves as shadow banking and they should now go out and grow. So the government and the regulator wants this sector to grow. Which is the reason why we are all looking very closely where in the large space can we find our growth.
All right, Digant, then let's take that forward and let's focus first on the housing finance companies, because it's more relatable as well. Now, housing finance companies within that, some of them could see some margin expansion, as you said, because of the rate cuts. Lower cost of funds will help them. There is also backed by physical assets, which is good in terms of asset quality. And within housing finance companies, well, we'll break it down into traditional housing finance companies and affordable housing finance companies. First, on the traditional lot. And we'll get those graphics up for you on the screen, the likes of LSE, Housing Finance and the likes. Yeah. Anything you like out there? Is there one of those companies that is better placed?
Nigel, I think, traditional housing finance companies, you highlighted a lot of positives, but then, all these positives come with very high competition. All private banks, all PSU banks, all regional banks, everybody wants to do affordable housing, and which is why the margins and growth both will be under pressure for this segment. So this is a segment which is best left for, somebody who's happy with 10% returns, because I don't see, a big upside in any of the stocks in this particular sector. I think if somebody is still very keen, maybe Canfin Homes has a little bit of turnaround story left, but otherwise I think best to focus on smaller names, niche names where banks cannot really come and compete.
So we'll keep the traditional housing finance. They're not giving you anything to really be very excited about. But let's focus on, the other ones. That's the affordable housing finance companies. And when we talk about real estate companies, their advice is always go with the larger names. But I believe from this space, you are looking actually a smaller name from the affordable housing finance. India Shelter, that's the one that's on your radar. I think it's well placed, though the loan book is the smallest, but the ROA is looking quite good. Tell us more and what's the rationale?
Yeah, so I think, the affordable housing story of India, a lot of times we say there's so much opportunity. Actually, that's not true. The opportunity is limited in affordable housing because all the housing prices have gone up. So in housing finance, we have one rule, Nigel, that you focus on companies which are small in size, because the moment you hit 20-25,000 crores in loan book is the moment where either your growth or your asset quality starts suffering. We have seen that with Gru in 2016, Canfin in 2018. These were also great affordable companies at one point in time and they're struggling later on. We've now seen it with Awas and some extent Aadhar also. So this is a space where I think smaller is beautiful. And I think amongst the small space, there is Aptus and there is India Shelter, which is like less than 10,000. Between the two, I think India Shelter has a better growth focus and better prospects of growing and maintaining their profitability. So I think that can be a business which can do well over next 18 months.
Yeah, and as you said, I think the loan book is less than 10,000 crores out there, but it gives you a good potential to grow. Just wanted you to highlight, what about the LAP exposure for these companies? How much is it?
Okay, so that is slightly, like we say these are housing finance companies, but anywhere between 25 to 40% of their portfolio is in loan against property or LAP, as we say. It's a slightly risky segment, but that is what gives them margins. These players over the years have really done it well, but there's a little bit of risk build-up. So you always have to be careful and not go overboard because, mind you, Nigel, these are all trading at 3.5 times price to book also. So they need to execute well. I think India Shelter over last 2 years, they have had a new management from Chola and I think they're doing things right. So I think that is where we have the best probability of success. But yeah, we have to be careful about LAP.
Pick of the pack, India Shelter from Digant there. Loan book size relatively smaller, but they've got triggers. And that's why Digant says that they're favorably placed. Digant, I wanted to ask you about the asset quality. On the asset quality side, particularly in various pockets, MSME, 2- and 3-wheeler space, there are suddenly some signs of some pressure. Right. For the sector on the whole, how are you reading it?
Yeah, so see, I think the pressure is in the high yield lending space. Like if we break down the entire lending space, the pressure is in the high yield lending space. So you look at microfinance, you look at personal loans, you look at unsecured business loans, and lastly, you look at these 2-wheeler, 3-wheeler loans. So these are all places where you lend at more than 20%. There is a stress. The stress is not come today. It is building up since the last 18 months. Yeah. I think another 6 months and we will find our feet. So it's not something which is alarming to me. I think we have already seen bad patches. We are about to, end those bad patches in coming quarters.
Yeah, that's heartening to hear because let's turn our attention then on the vehicle finance companies itself. From that space, HDB Financial, well, it recently listed. And those that bought in the pre-IPO would be a little bit worried, because the IPO came actually attractively priced. Right. Now, going at the current state of affairs and, the valuations that it trades at, what's your view on this name, HDB Financial? If you compare it with the traditional darling, that was Chola, always got the best in terms of valuations. Right. Out there, between the two, good pedigree, good parentage, what's your pick? How would you approach both these two names?
Yeah, I think, see, Chola, there is very little to complain, but the macro setup is really we were at the best possible scenario for the last 3 years. Good truck prices, good number of trips. So everything was going good. I think after 3 good years, we have a high base and, we are slowly decelerating. So somebody like Chola, who has seen amazing valuation expansion, amazing returns, I think that should rest now. The best days for Chola as a stock, maybe 1 year is a time of consolidation for Chola, maybe even a little bit of correction because it has run ahead in terms of valuations, around 5.5 times price to book. HDB Financial, on the other end, it has struggled over the last 2 years in terms of asset quality and operating costs. But I think if cycle improves, which is our thesis of this show, that, the lending cycle will improve in the next 4 quarters, I think HDB Financial can meaningfully outperform Chola. Not to say that, these are like small caps who can go up a lot and something like that. But between the two, I think the funds may actually end up shifting from Chola to HDB if HDB shows a little bit of execution. All right. So, and HDB is much more cheaper. So
absolutely, as that chart is telling you, HDB is still relatively more attractive priced if you look at it against Chola. So we take that on board. And in the near term, you would say, if someone is looking at a fresh investment, you'd rather pick HDB over Chola for the reasons that you've given. What about Shriram Finance? It was attractive. Then it became even more attractive, made its way into the Nifty, and it's a frontline name. Valuation cushion, but what is your view on the stock?
I think Shriram has also done really well. If you look at last 3 years, it's done better than Chola also, which will come as a surprise to a lot of the observers of this space. But I think, Shriram should also rest. Just like Chola, I think Shriram should also rest for some more time. Their numbers, we are at 3.5% ROA. So, when you are at a high base and the environment is not very favorable, you may not show very strong earnings growth, and stocks typically don't do well. It's a great business model, great company. But I think, you will get better opportunities after 6 months or 9 months.
Okay, let's talk about then. So Shriram, Chola, maybe a bit of a rest. HDB Financial is something that could relatively better place. But let's talk about a stock actually that's done very, very well. L&T Finance, the stock is up, I think, close to 50% in just the last 8 months or so. It's re-rated a fair bit. But since Mr. Sudipta Roy, since the time he took over, there's been a lot of good news that's coming in there. And we just spoke to them actually. They said that they'll grow by 20-25%. That's good. But they only cautioned that the MFI industry, that recovery could be pushed back by a quarter. Your view on the stock, it's already seen some part of re-rating. Is it getting started, or is the best already in the price?
Okay, so see, they had this turnaround 3 years back when the new CEO joined. He changed the way credit is done, especially in two-wheelers and tractors. So I think that turnaround will be visible, from say next quarter or Diwali. And microfinance, as we say, is a pain for everyone.
Yes.
But if you look at the comparative charts, the pain for L&T Finance, Ujjivan, and Credit Access, these three companies, it has been the least. Like, so they have been the best 3 out of the 40 microfinance companies. So I would think that this is one place where you have a large name, comfortable valuations, and good potential, combination of all 3. So if somebody is looking at the larger blue-blooded names between, say, Shriram, Chola, Sundaram, Mahindra Finance, L&T, I think L&T is a hands down, can be a better performer than the other large names.
But the only point is, after the recent run, it's not that cheap compared to what it was. That said, what would the fair multiple you would give it, for L&T Finance?
So, see, L&T Finance, all other diversified large groups, who have corporate backing, they're trading at 3 to 5 times price to book. This guy is at 2 times.
Yeah.
Obviously, it is because the ROEs are at 11-12%. I think as the ROEs re-rate, which they should over next 18 months, I think the valuations also have room to expand. So you have a 20% room to expand in terms of valuations, and then earnings compounding is what people can earn. And in absence of all other ideas, a lot of money can flow. So valuation expansion can be a bigger game as well, which we cannot predict today. But if Sundaram, Shriram, Chola, do not attract money, the money is going to flow somewhere else.
Well, Digant, so that's about the vehicle space, vehicle financing space. But I think the space that gives you some comfort is with the way gold prices have moved up. These gold finance companies actually could be pretty well placed. And also the commentary that's coming from the RBI, particularly in the last, I think, 10 to 12 months, has been favorable. That said, just give us a couple of basic numbers first. What is the size of the opportunity out there? How much of it is unorganized? How much of it is organized? The split between organized and unorganized?
Okay, so see, credit card, people like us, we get credit cards. We can just go and swipe whenever we want. Gold loan is sort of, a credit card for the businessmen and credit card for the poor. Like, whenever you need emergency loans, you pledge your gold, you get the loans. It is no more a distress loan in India. It's not as if when I don't have anything and there's emergency. So it's like a business loan. So instead of playing a personal loan company or a business loan company, gold loan is a preferred bet. That the overall industry is very huge. More than 15 lakh crores is the total industry size. But half of it is controlled by money lenders. Money lenders charge 36 to 40% interest rates. And it is almost criminal. Those rates are so high that, I think these NBFCs charge between 14 to 19%. So they have a very good case. The banks generally charge between 12 to 16%.
Okay.
So that is the spectrum. I think this is an industry which is growing because, one, gold price is extremely favorable. 2, the regulator has streamlined the guidelines, and the guidelines are actually in favor of the sector growing faster. And 3, you have more and more players who are coming in the gold loan industry, like Poonawalla is starting with 400 branches, L&T Finance acquired Paul Merchants, and so on and so forth. So when everybody markets gold loan, the industry itself expands.
Okay.
And when personal loans and microfinance loans are not easy to get, gold loans is something which shines.
And this 15 lakh crore, as you said, it's divided into 50% each of them.
Organized and unorganized.
So for the industry, what kind of growth rate are you working with for the organized sector?
So Nigel, I think these numbers may sound insane, but 20% is a bare minimum growth in gold loan industry, which we can see this year. That is when our credit growth is going to be 9-10%. So it will grow 2x that of the system, and because of all the 3 factors which I just highlighted before. One factor which every investor has to keep in mind is you have to keep your eye on gold price. If there's a big crash in gold price, then gold loan companies cannot do well for 6 months. That is a patthar ki lakir, or what do you have to say? It's a very big thumb rule.
Okay, all right. Muthoot, that's been the big daddy, right? It's always enjoyed those premium multiples in the space. But that's what could limit the upside. Instead of Muthoot, would you rather play the other ones that can now twinkle? Say a Manappuram that's got new ownership, or an IFL that's coming out of a ban. Yeah. So among these 3 names, at least, what do you like?
So I think there's a spectrum. Each kind of investor can pick what they want. Muthoot Finance will probably do the best because it is best suited to capture all the growth. But Muthoot Finance probably more for the large funds, for people who are happy with 15-20% kind of returns. For people who want to play a recovery trade, I think IIFL has a wonderful gold loan book. They will show you the sharpest upsurge in growth because they had an RBI ban and so on. And there's one more interesting company called FedFina, which is a subsidiary of Federal Bank. I think that is something which got listed a year back.
slightly undiscovered by the market. And, to your surprise, in gold loans, we look at what is your per branch AUM. So Muthoot is number 1 with 21 crores of gold per AUM. Number 2 is FedFina. It is not Manappuram. It is not IIFL. Number 2 is actually FedFina. So, FedFina, IIFL are interesting. Manappuram, the new CEO is about to join. They have some more pain in the microfinance. So, maybe I'll wait for a quarter or so for it to settle and then we can move ahead. But these gold loan companies are really better placed than the personal loans, companies like, say, Bajaj, Poonawalla section, which will come to the next.
All right. So in terms of preference, maybe Muthoot will not shine as much from now on. It could be a compounder, though, from here on. But the delta could come in from companies like FedFina and IIFL, as well as a Manappuram. Well, you spoke about some of those consumer-facing finance companies. I'll tell you what. We'll slip into a short break. We'll come back and we'll continue the discussion. Digant will tell us what's his view on a few of those names as well. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha on CNBC-TV18. Well, we're still in conversation with Digant Haria. Digant, we have discussed a few themes, but as promised, we're going to be moving now to the diversified consumer lenders. Bajaj Finance, that's been the poster boy, right? If you ask anyone in 15 years, where did you make your money? They would say Bajaj Finance. The problem is now that the numbers, even when they're good, people want more. Ye dil mange more, right?
Yeah.
Do you think Bajaj Finance has run its course? or can it give, I don't know, maybe a mid-teens, double-digit returns from here on?
I think it has run its course. It's very, it's a very harsh statement to make, but I really think that it has run its course. If you look at last 9 years, the stock price CAGR of Muthoot Finance has been higher than Bajaj Finance. A lot of people don't know this, but this is the reality. See, Bajaj was a leader in physical world, buy now, pay later. You go to a shop, buy a TV, buy this. Now shopping has moved online and Bajaj is no more the leader there. So Bajaj, the main reason why Bajaj is struggling is it is no more a leader in any fastest growing segments. So Bajaj has been moving to different segments like gold loan, micro loan, tractor loan, everything which is traditional. Bajaj never did traditional stuff.
Yeah.
But now because they are not able to grow, I think they have reached a size that unless India's middle class and lower middle class does well, Bajaj cannot really outperform. So Bajaj's outperformance is now so much linked to what happens to the entire middle class. It can no more outperform the country in a big way. So I think we can, personal loans, MSME loans, two-wheeler loans, the credit card loans, they're all struggling. And, which is why, apart from Bajaj Finance, we should also be very cautious on companies like, say, an SBI Cards or companies like Poonawalla FinCorp, which are talking of very fast growth in such an environment. I think these are places where investors will have to wait a lot before they can see returns.
All right, so Bajaj Finance and Poonawalla FinCorp, for the time being, you would not be, looking to jump into it. But I want to ask you about SBI Cards, because that's the only listed credit card player, right? Credit costs remain elevated. Every time, there is something or the other, and now the best is yet to come, it doesn't come. Even, the past quarter's numbers haven't been that impressive. So asset quality is an issue, credit costs go up, growth is not coming about, they're not making any big dent in any market share. What's your view on the stock? Because if you look at rank underperformers, this is one stock that comes to your list.
I'll just give you one line, Nigel, that in credit cards, if you want to make money, you cannot sell credit cards at petrol pumps, at malls, at railway stations. If you do it this way, you invite a customer segment which is not very strong, and which is why your asset quality issues never end. So 2021 to 23, their sourcing strategy itself was, you go much lower down the pyramid. And which is why you see quarter after quarter losses come and management is clueless.
Okay, all right. So that's aside. But JM Financial, that's something that you've liked. What's it? What's happening out here? Does it have more legs?
Yeah, so it's a capital market play. And if you look at this stock, 2008, the price was same as it is today. So it's almost 16 years. The company went through a lot of pain in the NBFC space. They have come out of that pain. So I think good times for the company are just about starting. It will be a very interesting capital market play to track for the next 2 years, because it's like a long 7-8 year of pain which is coming to an end. And capital markets division is doing very well. So instead of a mutual fund stock or a broking stock, we prefer something like a JM Financial where, there is a lot more steam in the business.
And it's got valuation comfort as well, even after this big run. So that's something that you like.
Absolutely.
All right, let's wind this down then by turning our attention to the micro lenders. Companies like Credit Access, Arman, they have 70 to 90% in this space, and they're pretty well placed. Do you like any of these two?
So see, microfinance is always cyclical. No matter what anyone tells you, there is a good cycle, there's a bad cycle. Right now, we are going through the deepest point of the bad cycle. Maybe in a quarter or two, from the deepest point, we'll start the upward journey. So if somebody is interested in playing cyclical stocks, I think this sector offers upsides. The best companies, the best managements are Credit Access and Arman in this space. But, we feel that microfinance, even in the upside, it will be a little slow because that over leveraging was just too much. So in this space, we like something else, which is Northern Arc.
But tell us more about this Northern Arc, because there was a pending large trade. It took place, got cleared out around 200 rupees. From there, that has been one of the biggest outperformers from the broader markets. So at around 260 ballpark, what's your view on this name?
Okay, so...
And what are the key triggers you'll be tracking on this one?
Perfect. So see, Northern Arc is a very unique company. They lend to 300 other NBFCs. That is their first business. Second business is they lend to small LAP, microfinance, just like, a lot of other companies, say SBFC or, 5 Star would do. So they have these two major businesses. One of the business, which is microfinance, had some trouble, and which is why the stock is trading at 1.1, 1.2 times book. I think the base business is so strong that once the microfinance down cycle is over and the up cycle starts, this will also re-rate quite significantly. So in Northern Arc, I see that there is a reasonable room, just like JM Financial or FedFina, there is a reasonable room for the business model to outperform in terms of earnings. So that is our business case in Northern Arc.
Northern Arc and JM Financial. But before we wind down, we had a couple of stocks on the screen, SBFC and Five Star Business. They traded around 4 times approximately. What's your view on these two names, or are you going to give us an alternate?
See, I think both are into that very high lending space and they're growing fast. So this is an area which I try to become a little cautious, that high yield and fast growth. There's a chance of mistakes. Valuations are also very rich, so there is no margin of safety. So I think gold loan companies in this environment, investors are better off being in gold loan companies than in these companies. Maybe once the environment improves, we can do a shift trade. But
all right, Digant, it's been a pleasure having you on the show. Thanks a lot for joining in, explaining all of that to us. Just to rewind, India Shelter is something that you like. From the gold finance companies, FedFina is something that you like. And from the other stocks, Northern Arc, JM Financial, they could still look from here on. And that trade you spoke about, maybe it's time for Chola to make way for HDB Financial. It's been a pleasure having you on the show, Digant. We look forward to chatting up with you soon.
I'll just say one thing, that investors need to be patient. This whole cycle, it will take 2 or 3 quarters for the cycle to really turn around. And yeah, be long-term, track the businesses, not the stock price. And whatever we spoke is business analysis. That's it from my side.
Well,
thank you for having me.
Bang on, Digant. On that note, though, we'll wind up on this edition of Finding Alpha. Thanks a lot for joining in. We hope we managed to dissect the entire space for you. More news and updates coming up on the other side.
Market headlines. To understand the reasons for the day's movers and shakers. And Get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Hang Seng currently trading 0.4% higher. The Taiwanese index too trading with gains of a similar quantum.
You were saying this is probably the biggest deal ever reached.
On daily charts, the next support comes in at 24,773. So it's down 0.25%, 24,785 on the Nifty.
Recovery in the rural, it has been excellent.
And most of the components right now, they are in the negatives.
In an AI automation world, we need fewer people. Fewer managers will be needed.
These are the kind of major big-ticket investments and commitments that the US and Donald Trump are seeking from India.
It has been that one-way fall on the Nifty currently.
Well, that is the day so far, and it's turning out to be a negative day. 160 odd points lower on the Nifty is what you have as things stand. I mean, you know, Friday the market broke the previous low, and today we are basically down to the near-term. Actually, we've broken near-term supports as well. So, will the market find? Try to build some base around here. We'll talk about why that perhaps is the reason, especially from a futures and options perspective. Lots to talk about here in terms of single stocks as well. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surabhi. Rima with me, guys. Good afternoon.
Hi, afternoon. The picture across globe is a lot better right now. I mean, look at Asia. Hang Seng closed with a gain of about 0.7%. The Korean market's up nearly 1%. Even in Europe, now that the deal is struck between EU and US, you've got some gains, initial gains at least, about 0.5% up on the CAC DAX and the FTSE. Perhaps the hope is we're closer to the end of the tariff-related uncertainty. The risk premium associated with the uncertainty is now ebbing. So there is green on the screen. But look at our own markets here. Look at the mid-cap, small-cap index.
But Rima, that's not been a trajectory of only 1 or 2 days. That's been the story of the last month and a half. And I was looking at exactly precisely this. If you look at the divergence between the S&P 500 and Nifty, in just the last 4 weeks, the S&P 500 has climbed 3.5%. Individual stocks are done even better. Nifty's down 3.5%. So the gap is over 6%, exactly. And of course, you have the trade optimism in Western markets, and then you have earnings. I mean, solid US earnings, right? Whereas we are dealing with the earnings issues, earnings casualties. Today's name, of course, would be Kotak Mahindra. We'll talk about that. SBI Card. Short point is that earnings, barring, of course, there are good names. I mean, Laurus would be a case in point. But these kind of stocks, big stocks, which when they come out with disappointments, something that was not penciled in, asset quality issues, it's a problem. And folks, I don't think we were going in with so much of asset quality concern in this quarter. Everyone was talking about margin compression. Market was prepared for that. But credit cost rising, asset quality becoming an issue, that's one more thing.
Absolutely. And, not very much to go with on the positive side, right? I mean, lacking in triggers. I just want to quickly run you through what's lined up here over the next 60 minutes or so before we go any further. And then we'll sort of get to trades, F&O, etc. So the sell-off in Dalal Street, of course, intensifying a little bit. Nifty has failed to defend the crucial 24,700 level. Real estate, metals, private banks, the worst hit. We'll take stock of the setup in the final hour trade. Stock-specific action, Laurus Labs, of course, is up about 5-6% the last I checked. We had the management with us, sounding quite bullish, actually. So that's something in a bit. IT pack, right? I mean, down just less than 1%. It's already sold off quite a bit, but it's another sort of downtick here. So we'll talk about this in the context of course, the announcement over the weekend from TCS, and we'll sort of take stock of earnings, which will come later. Indocent, Gale, Bharat Electronics are some of those which we will get you previews for. So that's the lineup here as far as the programming is concerned, and the stocks that you will see us discussing. But we want to quickly get to the action, don't we? So let's get to Mitesh with what he wants you to do in terms of specific trades here. Mitesh, are we at that point where you start to turn a little bit, think about the other side, or not yet?
Good afternoon, Prashant. Not yet is my answer, purely because, look at the market. The market isn't showing any signs of turning around. Barring a few pharma names, I think the rest of the market, majority of it, is still showing signs of this corrective pullback, kind of continuing, marginally extending. I talked about the fact that we could test 24,900, and if we break below that, we could even test 24,500, 550 zone. So I still believe that that's a likely outcome. Around this 24,500 or levels, give and take a few points, a couple of weekly supports kind of kick in. So I think that is the zone, where you would want to at least reduce your short exposure, take some profits on the short side, and then see if there's a reversal happening on the hourly probability charts, which I think we are still, few hundred points away from there. Having said that, on the stock side, I have one buy and one sell call. Dr. Reddy's, and I've talked about pharma as the positive setup. So Dr. Reddy's is a trading buy for me. Keep a stop below 1265, look for targets of around 1310. And on the short side is Adani Enterprises, which I would recommend selling with a stop at about 2550 for targets of around 2420.
Got that. This is going to be a big week globally in terms of earnings. 40% of the S&P 500 report earnings this week. They include tech giants like Apple, Amazon, Microsoft, Meta. You've got the Fed made, and to end it all, you'll have the jobs data. And back home today, we've got earnings from BEL, Mazgao, IndusInd Bank will be tracked very closely, and Gale. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is now with us on the show. Mitesh, thank you for joining in with those trades. We'll come back to you. Gurmeet, first, Kotak Mahindra Bank, 7.5% gone now. I mean, were you taken by surprise? What is the advice? Did you hold it in your portfolio?
So, Rima, actually, they gave a very good Q1 update, and the stock ran up actually along with HDFC and Bank Nifty. And then Q1 earnings was a miss. So it's more of a bit of a reset if you see the movement in Kotak post the Q1 update. I think what slightly surprised the market was a larger than expected dip in NIMs. They were expecting about 20 bips. It came out to almost 30, 35 bips if my memory serves me right. Also, the credit cost marginally went up, which led to more provisionings also, especially in the CV portfolio and a little bit in the MFI portfolio. But I don't see any reasons for stress. Good banks tend to provision more. They've sold their general insurance business also some time back. So I don't think so there's a structural any issue there. It's just that the market was expecting, it's the positioning which was there, expecting a better set of numbers. But if you see the credit growth, it was about 14%, which is higher than the industry growth. Also, I think with more mobilization in saving, and maybe in a quarter down the line, even NIMs should stabilize. The NIMs in Kotak in that case anyways are much higher. It's above almost like 4.5 versus some of the other banks. So I don't see any reasons to be worried. Also, the stock is consolidated for long. Disclaimer, we don't hold Kotak in our portfolio. We have ICICI, HDFC, Federal amongst the private sector banks.
Okay, Gurmeet, just coming to you. Good afternoon. Just the F&O setup, right? And let's bring in Mangalam. For exactly that, are there any indications from the F&O side, data points, PCR, etc., which gives us a sense one way or the other? Mangalam, take it away.
Well, the indication is more of the other way than one. We aren't likely to see any sort of immediate up move. That's what the data is suggesting. Earlier there were indications of the market being oversold, and thereafter there could be some sort of recovery, and that's exactly happened in the first hour of trade as well. But thereafter, once those recoveries were sold into, the bulls have thrown in their towel, and that's exactly what we're seeing on the frontline index. The Nifty Bank, as well as the Midcap index, all of them lower, and the India VIX, which was factoring in complacency over the last two trading sessions, has seen a big spike. Now from the lows, it's rallied almost 20-21% from the lows that we saw just before Friday. And broader markets as well, there too we've seen some towel throwing coming in, because at around midday we had 1,000 stocks advancing. That number's now fallen all the way to 600, and the number of stocks which were declining have crossed past that 2,200 mark as well, telling you that both the red and the green lines are the widest distance that they've been all through today's trading session. Earlier we also saw the 24,800 put see some writing, hoping for support come by around that 24,700 mark. But now if you look at the 24,800 put, positions are being unwound out there. The writers out there have been caught on the wrong side, and the open interest out there has come down as well. Importantly, the writing on the 24,800 call, 24,700 call continues unabandoned, and the 24,500 put writers are now finding some sort of action out there. So the street believes that maybe supports coming lower for the market from 24,800, 24,700 to come down to around 24,500. And the put call ratio, which was already at the lower end of 0.7, has now come in at 0.6 as call writers have increased their positions and put writers are winding down some of their positions. So now the next important level, if the market fails to hold the 24,500 mark as well, will be the 100-day moving average on the Nifty after having fallen from the 50 and the 20-day moving average. Amidst all of this, there are a couple of stocks which are seeing some amount of bidding, and we have Amber Enterprises. That's actually outperforming in an otherwise bleak market. Short positions out there are being unwound, so some short covering on that counter. But Laurus Labs and IEX, I'm keeping a very close watch on. Laurus Labs, in all probability, enters F&O ban today. And IEX as well, very close to the threshold level of entering F&O ban. So that's another stock we'll watch out for. Remember, IEX got out of the F&O ban just in the previous trading session.
Okay, absolutely. You need to keep an eye out on this one as well. Manglam, thanks very much. And Laurus, definitely. We'll get the fundamental check on Laurus in just a bit. Stock's done very well after the numbers. Speaking of numbers, quite a few came out today and not inspiring much confidence. Actually, even where numbers are decent. For instance, Nippon Life, which is the mutual fund business, numbers were decent because you've got at least double-digit growth on the top line and the bottom line. And that's rare in a market like this. But the stock not doing too much, down about 1% or so. TTK Prestige was a weak set. Decline, top line, bottom line. Not a great quarter for TTK Prestige. Stocks down about 0.5%. But the two stocks that I want to put the spotlight on are from the defense space. And these are smaller private sector defense players. Zen Technologies and Paras Defense. And this is what the stocks have done after the numbers came out. Both have had a rough quarter. For Zen Technology, I mean, there's a major decline now. Year-on-year, revenue is down. Margins have compressed 300 basis points. For Paras, there is revenue growth, 11% revenue growth, but there's a margin compression of over 500 basis points. And given the rally, especially since April in many of these stocks, clearly the market is disappointed. Gurmeet, hi, good afternoon. You know, we always discuss this, and you're a specialist in this space, right? Having picked Solar Industries. So help us out here. I mean, a lot of people who would have bought these smaller private sector names going beyond the HALs of the world, they would be very confused, saying, should we hold on? This is just a one-quarter aberration? Or does it mean that this is too risky a space? What would you say?
So, Subi, it is tricky, and you've got to probably, and it's a very technical business, and you need to understand the lumpiness of the business because it's dependent on government orders and export orders. Zen Technologies, in this case, I think the subsidiary saved them the blushes, otherwise the numbers would have been even softer. I think what they have mentioned is that they will, over 3 years, they will do 6,000 crore stock. And that is where you can't take it quarter on quarter, right? So recently they got one more patent and then the stock ran up. And, the stock moves like this. When it went down from 2,500 to 1,100, we kept seeing lower circuits of 5%. And then from 1,100 to 1,900 also was 6-7 days of 5%. Okay, but, to their credit, they have 23, 24 patents. Because of the emergency procurement by the government in army, the normal orders, there is a bit of a delay. I think, the second half could be better. Also in simulators, which is where the biggest market is, they have 100%. They have 100% market share there. So as more orders come up, they should do well. And they're doing a lot of stuff in the anti-drone system as well. Have about 24 patents, if I'm not wrong, one of the highest any Indian companies have. So you have to live with this volatility. You have to, look at and see what it has done in the last 3-4 years and not see it on a daily basis.
So you'll be a buyer of the dip. So Zen is a thumbs up. What about Paras?
Paras we don't have in the portfolio. So we have Solar, we have Zen, we have Bharat Electronics, and we have small exposure in HAL now. See, India is down to now 29 squadrons. We need like 43 in case tomorrow if we have a three-way war. And once this engine issues get resolved, you will see, massive order book playing out. Also now 60% of the revenue comes from service and repairs. So that also gives you some kind of stability and not as much as lumpy as some of the other businesses are.
Okay, so Solar, BEL, Zen, and a little bit of HAL. That's your defense portfolio right now.
I just want to say one thing. I just went back, Surabhi, if you remember, the first show on Editor's Playbook was defense, right?
The defense opportunity.
So I just went back and looked at where we did it, right? We did it on the 15th of May.
It was just after Operation Sindoor, I think.
Yeah, so 15th of May.
Yeah.
Guess what? The Nifty Defense Index, from that point, had a nice not a very large rally, but it sort of, because there was a phase when things were going well and all the beaten down names like Idea Forge, which had for years done nothing, they were all coming back.
Correct. Yeah.
We are exactly back at it's like a round trip. We're back at the 15th of May levels. The short point being that I think, and we were making that point back then, that, news flow and everything is one thing, but when you're buying stocks, you have to be careful about what you pay.
Yeah.
Because otherwise you get carried away, right? In terms of in terms of what you will pay. It's like rising tide lifting all boats, but not boats are equal in that sense. So I think it's important. Even something like an Idea Forge. I mean, actually I'm surprised. I'm looking at this now because I thought it rallied quite hard. I mean, from 360, 370 levels, just had a one-way move to about 650. It's back to 450. From 650
fizzled out very quickly for
650 to 450.
Yeah.
So yeah, I mean. So you got to be mindful and be careful of what you pay. Otherwise, especially when you have a little bit of a frenzy, momentum, you buy something and then you're stuck. Then you don't know. You're waiting for they probably wait a while for you to sort of get your price back. It doesn't apply only to defense, applies to everything. But I just thought make a quick point. Laurus is the one that Rima was going to. So let's just focus on that a little bit. Stocks up about 5.5%. Let's get the details of the results first with Ekta, who will play out the sound bites.
Well, yes, Laurus Labs, the guidance in the conference call has been quite encouraging post the numbers that came out during market hours on Friday. So they've said that the CDMO revenue is expected to grow from the current 30% to potentially 50% of revenues in the medium term. CDMO revenue is expected to be around 2,000 crores for FY26. Gross margins could possibly expand to around 55 to 60% in coming quarters. They did not provide a quantitative top-line guidance for FY26, but they've said that they've laid the strong foundations for FY26 and beyond, and they expect margins to improve in FY26. Goldman Sachs has a sell, but they've raised their target price to 675. Jefferies as well underperformed, raised the target price to 590, and Kotak Institutional has raised their target price to 555 and have a sell rating on the stock. In fact, let's listen in to what the management had to tell us earlier today.
Our gross margins were always between 55, 57 in the previous quarter. This quarter, because of higher revenue contribution coming from CDMO, the margins were over 59% now. Looking at the prospects, what we have, and we estimate the gross margins will remain between 55 to 60%. Primarily because of higher contribution coming from non-ARV and also increasing revenue share coming from CDMO. In 2021 financial year, our revenues of CDMO was 500 crores. Now we were able to move towards 500 crores per quarter. And we estimate the run rate looking good. As you are aware, CDMO business is bumpy, but for the entire year, we expect the CDMO revenue contribution will be over 30% for the entire year.
What a move in Laurus Labs. This year itself, Gurmeet stock is up nearly about 48% now on a year-to-date basis. Your thoughts?
So we continue to hold, Rima. So I've seen 70 to 700, then back to 250. Now a new high almost made today at 900. Again, very lumpy business. And I think in between they did heavy capex, and that did not come off the way they guided. And that led to severe underperformance in the entire bull market of 22-23. Laurus did not participate. And now once you have molecules getting commercialized, if you see the numbers of export month on month, June was almost 107 million. And now they've also got a big land allotted by Andhra government, where they've committed heavy capex, more capex than they've done probably in the last 10, 15 years or next 4 or 5 years. I think that is also one trigger for the stock to work, and promising employment also. So I think their chemistry skills, their ability in CDMO in terms of late life cycle strategies, and I've been saying this for a while, that CDMO is where IT outsourcing was in 90s. And I think there's a huge opportunity once the Biosecure Act, if it gets passed and sees some light at the end of the day, I think a lot of our companies can do well. Catalent, Lonza, some of the Chinese companies do $6, $7, $8 billion top line. The largest one in our case does what, 600-700 million, which is Divis. So Laurus is already talking of 500 crore CDMO per quarter. which will what 2,000 crores for the year. Still a fraction of what the global market is. So I think there is an opportunity here. But obviously, as I said, it is a lumpy business, and players like CDMO, defense, you got to size your bets well. Diversify it. Don't go overboard in terms of having 10-15% weight in the portfolio, and have a 4-5 year view in terms of the R&D they are doing and what will pay out. It's extremely important not to chase momentum here.
You liken the CDMO opportunity to Indian outsourcing in the 1990s. Well, Indian IT outsourcing, the penetration, the arbitrage was very promising. But now in the age of AI, all that is getting questioned. And TCS's news flow over the weekend really rattled and shook sentiment. 2% of workforce on their base of 6 lakh plus. We're talking about 12,000. And TCS isn't alone. Even HCL Tech, and I think that news sort of got missed, but HCL Tech also clearly spoke about people and non-people facility restructuring, which will play out in FY26. They didn't give any details, but they specifically said we will have people restructuring also in FY26. So clearly tough times. Global giants have already announced, job cuts, and they have been for the last 1 or 2 years, but now it's hit closer home. What have you made of all the, news flow? And, is just this the start? And we are going to see aggressive headcount cuts. And how will the investors react to this?
Obviously, they haven't done as much R&D as they should have, considering the cash balances most of our large IT services companies had. But there have been exceptions. There have been exceptions in mid-cap IT, especially Persistent, Coforge, maybe KPIT to an extent. In general, now we are hit with an auto slowdown, but maybe with the trade deal with the EU and US, where EU talks of only 2.5% import duty to US, it might be just good news for KPIT and auto, as a sector as a whole. I think some of the bad news is in the price. If you see the price action over a period of time, and we should not write off Indian IT services companies. I think we've made this mistake so many times. But AI is a bit of a genie out of the bottle. So we'll see how it goes. But I think we have the ability to pivot and really contribute towards it. They have the cash balances. There is a realization there. But for now, I think it's better to be slightly underweight there. Maybe tactical bounce can happen once the trade deal happens, or there is a some positive news flow order base. In our case, we are less than 5% in IT services. We have HCL Tech amongst large cap. And we are looking at adding in case we get better price points between Persistent and Coforge.
Okay. Got that. Gurmeet, come on, time for a new name.
Nothing new, Prashant. We've been, as I said, researching I think one space which has been out of favor has been chemicals, under-owned. 2-3 years of inventory destocking, price points. So we added JG Chemicals, which is into zinc dioxide and recycling of zinc. The end use is tire, and now they're expanding the end use to ceramics, specialty chemicals, pharma. That's done very well for us. We added at around 350 odd levels, so it did do well, and now there's a bit of a retraction happening. We are looking at some tactical plays in refinery space, considering the valuations. A lot of them are now. Some of them are like half of replacement cost, or maybe 1/3 of replacement cost. And with I think inventory losses behind you, shutdowns behind you, diesel cracks improving, you might see very good GRMs and sudden bump in profitability. Those are more tactical in nature. And we are, as I said, looking at some more opportunities in the recycling space. That's one space I really like. We call it a circular economy. And I think that's something where the market size is too small. So we are looking at increasing weightage in the likes of Vatek, Ganesha, Gravita, and some of the other names.
Okay. All right, Gurmeet, we'll leave it on that note. Thank you very much for joining in and giving us perspective. Quite helpful in times like these. We do have to take a very quick break. Market, well, still nursing a cut of about 150 points on the Nifty. Midcap index still down over 400 points. Take a break. We'll get some perspective going with Nitin Bhasin, Head of Institutional Equities at Ambit, as we get through what has been so far a disappointing Q1.
Welcome back. The Nifty below 24,700, 150 points gone in the benchmark. Sensex down 550 points. What about individual stocks? Hormus is here to put the spotlight on mid-caps and small caps.
There are plenty of movers within the broader markets today, and some of them are earnings reactions, some of them not so. But we'll start off with Paras Defense that came out with results on Friday. In response to that, the stock was down 3%. And today, the stock has seen a 10% knock as well. And that is the biggest single day fall that the stock has seen since June 2024. And now with this fall, it is moving towards its 100-day moving average of 684. And this is also down now 30% from the 52-week high that it had just made in the month of May. So within the next 2 months, the stock has corrected 30% from those levels. Another earnings reaction which came out last week and since then has been sulking is DAM Capital. Another 7% knocked off in today's session. It's down 12% in the last 3 sessions. Now already trading below its IPO price, but it has already halved from its post-listing highs, which were well over 450 rupees. So continuing to see some value erosion, and since the 17th of July, the stock has gained only once. Northern Arc Capital is the other one. That too has taken a big knock in today's trading session. Another 7% gone today. It's the 5th straight day of losses, down 13% in the last 5 trading sessions. And even this stock now trades below its IPO price of 263. Now the fall here in Northern Arc Capital comes on lower volumes, which are less than its 20-day average in today's session. On the positive side though, Cartwright Tech came out with numbers earlier today. The stock saw a bit of a dip and then has seen a one-way move on the upside, 10.5% higher on that stock. It was a very strong recovery that the stock had post-earnings, and this was one of the biggest underperformers in terms of the new age companies until March of 2023 when it made a low of 350 rupees. The IPO price is 1600, and since those levels, the stock is up almost 6x, and today it's traded almost 40 lakh shares compared to the 20-day average of just 3 lakh shares. And lastly, JK Paper is one of them. At one point, paper stocks, everybody spoke about them, but today the stock is down almost 5%, down 6 in the last 7 sessions. And the last 3 years, the stock has had negative returns, even you compare in absolute terms. And this is after gaining 90% each in 2021 and 2022 as well. So plenty of movers on the downside, some of them trading on lower volumes despite seeing a big knock in today's session.
Right, Hormus, thanks very much for that. So that is the unusual movers pack with Hormus as always. Nitin Bhasin is with us, head of institutional equities at Ambit. Nitin, good afternoon. Good to have you with us here. Thanks very much. I mean, I think the big talking point is, of course, what's happened with the IT services, and Rima has been covering that for us. And Surabhi was reminding me that you had a bit of a, you were constructive on IT, Nitin?
Yes.
Back in March, you still hold that view after the result season? Maybe too late to sell, but I mean, do you think it'll make money from here?
I think you're right. For the last month and a half or so, our strategy call was to go underweight on banks and perhaps increase weightages on IT. Hasn't worked out. In the last 1 month, IT sector has underperformed the bank Nifty by about 5 or 6 percentage points. I think clearly that's what the past is. However, we are continuing to see that there is more risk building up on the credit in India in terms of credit growth, in terms of NIM margins, etc. So we believe that if you were to take a little longer view of 3 to 6 months, our view for the midterm for our investors, institutional investors, is from here on perhaps to not that much of risk of FY26 earnings estimates, at least for the large caps in the IT sector.
But Nitin, I mean, just elaborate on that call, because earnings estimates anyway, they're so feeble, right? We're talking 0 to best case 3-4% growth. So what is the view? I mean, is it just going to be a play on the cash, maybe better buybacks and dividends? Or is it that you're bearish on other parts of the market? Like you mentioned, banking. So I'm sure the call is in tandem with the other tactical allocation. So just elaborate on that. And also the negative view that you have banks, that's turning out to be, absolutely spot on, at least just looking at short-term earnings. I mean, first quarter has been really disappointing. Barring HDFC and ICICI Bank, most others have disappointed, either on margins or on asset quality or both.
So, fair point. I think what we've been highlighting is that we are into the fiscal year in which the flows are reducing because of the last 12 months of Nifty performance or funds performance, because of which, and entering into a fiscal year where the earning estimates are very feeble. Again, remember, the whole Nifty is not supposed to grow earnings more than about, let's say today, 8 or 9%, which is not any different from about one quarter back, 9 or 10%. So in a market environment where flows are perhaps reducing, number two, where the earning estimates are very, very frail or feeble or low numbers, where do you actually go and park your money? We've seen such cycles in India in the last 15, 17 years, twice play out for about 2.5, 3 years, where market has increased in concentration, and which profits start becoming concentrated. And hence, the three sectors which have performed in each of those two cycles in the past, when we've had that in 2010 to 13, or let's say between 17 to 20, what we've seen is IT, FMCG, and pharma have historically, delivered or outperformed the market. That could be one of the reasons that we have in saying that where the market moves, perhaps for the next 6 months or 12 months or slightly even longer. We've already seen market move sideways for the last now 9-10 months. Where do you go and lose less money? Perhaps that was the call. FMCG, pharma, which includes healthcare also, plus now IT. So that was one of the larger thinking behind this call. In the near term, what we said was the IT sector has seen a lot of downward revisions in the last couple of weeks or 3 weeks. And with that behind us, we thought that it's right time to add IT, but clearly hasn't worked out. But we said banks would actually go through more downgrades. It could continue in June as well as in September quarter.
So Nitin, the call is in the second half of the year, things get really tough for the Indian markets. We're in for a correction.
So clearly, I don't know about the market correction. We've seen periods in the past where we have seen markets move sideways, not generating more than about 2 to 4% CAGR or -2 to -4% CAGR. Because what are we looking for? We're looking for flows to pick up in India with a considerable trend, or we're looking for earnings trajectory to actually recover. Clearly today, FY27 earnings may be looking buoyant, but FY26 earnings clearly aren't looking buoyant. And if you look at the flows also, last one quarter may be good, or 1 month may be good for domestics. But again, FIs have turned sellers in the last 1 week or fortnight. And what we see is pretty much a very unpredictable or not a very secular trend of flows. So hence, where earnings visibility is, at best, high single digits, or perhaps, low single digits or mid single digits, and flows moderating, I don't see markets going considerably to higher levels. It could oscillate for the next 6 months to 9 months also.
Speaking of earnings, that's a big top line miss for BEL. It's a wide miss, almost 600 crores of a miss. The profits are fine. Maybe at the top line, it could be some spillover effects, some orders moving in, maybe to the next quarter. The revenue estimate that we were working with was around 4,800 crores. The company's done, far lesser than that, though the EBITDA line and the margin line is not too bad. And that explains why the stock perhaps is holding up. In fact, they announced an order. BEL, in fact, just over the weekend announced a big order. It was a 2,000 crore rupee order. So that's what I'm saying. I'm not sure if that was expected to be accounted for in Q1 and spilled over to Q2. But anyway, that's BEL, and stock is in focus. We'll get you more on the earnings in just a bit. On earnings, Nitin, hearing you out, we started the year with everybody telling us FY25 was bad. We had 5-6% earnings growth. On that low base, 12-13% to ho jayega. But will it happen? Do you see those numbers come through for the full year?
I think I've shared this before as well, that if you look at the last 15 years in India, every time we start the year at about 18-19% earnings growth expectations, and we moderate ourselves down to 11-12%. Perhaps that's the signs of optimism every country or every market faces from the sell-side analysts. This year around, we started the year with about 10 or 11% earnings growth, and we've already come down to closer to about 8 or 9% earnings growth. Last I checked was that mid-caps and small caps have done slightly better than the Nifty earnings for this year. This quarter, with about 24 odd companies announced numbers, we're only up about 5% PAT growth as compared to 7% last year and 12% the quarter before. So I think earnings growth, as I said in the beginning, we're looking for, market always looks for, I think, earnings or looks for event or it looks for flows. Clearly, earnings are not playing out, flows are moderating. The event which is coming up to all of us is perhaps the festive season. And we all know that the consumption trends are again volatile. So the market will start looking at the trends of consumption going into the festival season. That information will start dominating the market moves or gyrations in the near term.
Nitin, just a quick word. So the big sector calls are you're bullish on tech, pharma, consumer, and you're negative underweight on banks. What about some of the smaller, themes like platform companies, quick commerce, or real estate, defense, realty, cement? What about, just quickly take us through the overweights and underweights here?
Sure. We've spoken about this, that as the market moves sideways, or perhaps it's very difficult to find trend-like behaviors in one particular index or otherwise. It's a stock pickers market. We've maintained that for the last 6-9 months. And you can see that stocks wherein the FIs came in the last 3 months, whether it was heavyweights such as Bharti, Reliance, an ICICI Bank, or an HDFC, those stocks performed really well. Whereas, where they sold, perhaps they didn't do that much well, whether it's an SBI or Infosys. So I would not hazard a guess at a single sector, a single theme, barring those 3 sectors which you mentioned, overweight, an FMCG, or healthcare/IT, I would say in the near term. But again, in that you'll have to be selective. So let's say even in IT, why should one be actually thinking of TCS? And why not things such as relatively inexpensive, can't actually see more downgrades like TechM, Infosys, or Cognizant? Those would be the ones. So I think we'll have to see what stocks, defense, etc. We aren't finding them to be any, beyond a theme right now. Hence, we would advise staying away from thematic, but more focusing on quality of companies.
Okay, and next time we will talk about specific companies because I think you sort of have a decent small mid-cap coverage universe as well. And on the back of earnings, I was noticing some upgrades, some earnings cuts, and so that kind of action as well. So we'll talk about that. For now, thanks very much, Nitin, for coming on as always here. Appreciate your time. BEL is not really moving very much. It's down 1.5%, 1240 EBITDA compared to a poll of about 1180 odd crores. So at an operating level, numbers are just fine. Margins actually are much better, almost about 350 basis points better than expectations. Take a break. Back with D Street Chatter with Nimesh. He tells us, of course, a sense of what he's picking up out there. Of course, a list of stocks he's watching, and we'll get you some trades as well. Stay tuned.
Welcome back. So the market is still nursing, a cut. The good news is that we're not at the lowest level for the Nifty, and at least it's not making lower lows. But let's see, still not very, very inspiring. And of course, a bigger problem in the mid-cap market with the mid-cap index down almost 1%. Nimesh is joining in with D Street chatter. Nimesh, red is the color this Monday. What have you been hearing? Dealing room?
Hi, Surbhi. It's largely a down day, dragged by a few individual sectors like financials, technology. These are the two large sectors, and because of tech, there is a bit of a second layer impact on the real estate names as well today. So the real estate index itself is also down more than 1.5%. So clearly, these are the three sectors which is dragging the overall markets down. But from a flow perspective, my sense is it's more of lack of buying than aggressive selling from the larger institutions. So the FI and DI data could be interesting to watch out. But at least my sense is there is no large selling is what I can understand or get a feedback from. There is very sharp reactions to earnings, and that's the trend which is likely to continue. We saw today what happened to Kotak Mahindra Bank, or a small disappointment, down 7%, and the other side, Laurus is up as well. So these individual stock reactions on earnings is likely to continue in the very near term. Technically, 24,450 is a level to watch now on the downside. That's a very strong support on the Nifty. So let's see if if you hold on to those levels, we're still a few hundred points away. And also the PCR after such a fall has come to 0.65 levels, and generally we've seen a bit of a pullback from those levels. So a pullback could be on the cards, but from a flow perspective, it's lack of buying rather than aggressive selling from larger FIs.
You're seeing sharp reactions to earnings, as you pointed out, on both sides, on the way down, on the way up. Cartrade Tech, Sudarshan Chemicals, Acme, Aadhar Housing Finance, Laurus Labs. What big moves. What about stocks, Nimesh? What have you picked up?
Well, so the first stock on my list is Marksans Pharma. There was a large block, 2.3% equity got changed hands. I understand it was a clean-out trade from an FPI investor of Marksans Pharma. So looks like some domestic funds were buyers. So disclosures would be quite interesting. But from a seller perspective, my sense is it's a large FDI investor who sold out completely today. So that's the first name. The second stock is Godrej Properties. I spoke about real estate under pressure in general, but Godrej Properties stands out on back of very strong selling. And also additionally, I understand there could be a large block in Godrej Properties very soon. Remember last week also a large FI sold out, and another large FI investor could be a potential seller in a block in Godrej Properties. So that's the second name. The third stock is Bharti Airtel. Even that's under pressure today. Aggressive selling is what I understand, and one long only fund seems to be an active seller in Bharti Airtel at current level. So that's the third name. And the last is a couple of stocks where I'm anticipating large block deals very soon. Paytm, Emphasis, as well as Flair Industries. In Paytm and in Emphasis, there are strategic investors who could be potential sellers. And in Flair Industries, the promoter entity could be a likely seller. So expect large blocks in these three names in the days to come.
Okay, all right, got it. Thanks very much, Nimesh, for all the buzz and the chatter. By the way, I just want to point out one stock, which is Bajaj Finance. Pull up the intraday chart. The market's been weak throughout, so was Bajaj Finance. But now it's picked up momentum, a lot of momentum on the way down. It's the second worst performing stock on the Nifty. That 4% down on Bajaj Finance, that's not a small cut. After Kotak, it's the next worst performing stock on the Nifty. We had Digant Haria on our news show with Nigel just a while back discussing banks and NBFCs. His point was that Bajaj is not present in the online space. Online, electronic sales. That is where there are other financiers, and it's traditional bastion of retail consumer finance that's getting challenged. That was one view, but anyway, this is a big decline on Bajaj. A good time to bring in Mitesh as well. Mitesh, just throw in a word on these big financials which are falling before you get to your calls. Kotak, no respite, and this Bajaj 4% drop. What do you make of it?
I think, I talked about that in the morning, that 1940 is the 200 average area. We should possibly head there. We're not very far away from there. Once it breaks that, then there's a good chance of it happening. I am even looking at a test of around 1880. So the structures turn weak for Kotak with this kind of a big fall. And similarly, I think, Bajaj Finance, the correction started, I think, yesterday, but rather on Friday. And now it's, nearing the support level. So Bajaj Finance for me, 873 to about 864 is a medium-term support area. We might not break it in the first chance and therefore get a bounce back. But I believe that the structure is weaker. So I think if you get prices around 900, 915 zones, I think that will be good levels to possibly for the short term, it is good levels to exit.
What about any other trading ideas?
On the stock side, I have sell or STBT on Havells with a stop at about 15.10. Target around 14.95 can be looked at. And the other stock is STBT on Hind Copper with a stop at 250 for targets of 242.
Okay. Got that. By the way, Mitesh, just one more stock, IndusInd Bank. Obviously, it's just ahead of numbers. Stocks at days low now. Just levels to watch on IndusInd?
See, the entire banking pack, post the quota numbers are coming to pressure, and IndusInd Bank had started correcting a few days back itself. The first level is around 765. So there's still about 4-5% trading downside left. In case you break that, and there's a good chance of that happening, I'm even looking at 725, 730 being tested.
Okay, all right. Sudarshan Chemicals is something we're going to talk about. Mitesh, thank you for that. It's up sharply. I mean, some 15% or so. Now, they reported numbers, but mind you, not for the first quarter. Okay, it's coming off as we speak. 6%, 7%. So it's not reported numbers for Q1 the earnings season that we are reporting on, but they report numbers for the fourth quarter. Sonal has got more. Sonal.
Well, do remember, Sudarshan Chemicals is surging in trade, but it is the Q4 FY25 earning that the company has reported. This is after the UBAC consolidation or the acquisition which was completed in the month of March. The company has said in its notes that Q4 FY25 numbers are not comparable to any other quarter. So that's why if we look at the revenue number, it looks quite elevated. So it's a growth of 76% on a YY basis for Sudarshan Chemicals in Q4. However, EBITDA is down this time around because costs related to the acquisition, they have shot up. That's why EBITDA looks lower. There is a profit element of just 31 lakhs, which compares with 58 crore rupees. There is an exceptional expense to the tune of 61 crore rupees. There are various adjustments that the company has made because of this acquisition, a huge acquisition that the company had made. So remember, this is not on the back of Q1 numbers that the stock is surging. We are still awaiting Q1 numbers for Sudarshan Chemicals, and that is something which will have more numbers from the acquired entity and also the outlook going forward for the pigments business. So that is something which will be important to track.
Okay. All right, Sonal, thank you very much for that. At least some green on an otherwise red-looking screen. Let's go back and look at IndusInd now. We just got a technical check with Mitesh, but let's prep you up for the numbers which are slated to be released today. Gaurav is with us. Gaurav, tell us, what's the expectation?
Well, when it comes to expectation for IndusInd Bank, we have already seen in the provisional update, the loan book has declined almost by 3%. So the weakness is definitely there. And as a result, they are expecting weakness in the results as well. So net interest income, it is expected to go down almost by 22% on a year-on-year basis. For net interest margin specifically, in the last quarter, there was a one-off impact. So on a reported basis, they may increase almost by 100 basis points. So they are expected to come somewhere in the range of 3.2%. But at a normalized basis, if we compare on a sequential basis, they are expected to go down almost by 20 to 25 basis points. Another point to highlight here is that the operating profit, that is likely to decline almost by 40% because there won't be any kind of push from the other income as well. When it comes to the credit cost and overall asset quality, now we are not expecting any kind of negative surprise here, at least in this quarter. We have seen elevated credit cost for the last quarter as well as slippages. So we are expecting some kind of easing in the credit cost as well as slippages, but they are still likely to remain elevated somewhere in the range of 1.8 to 1.9%. When it comes to profit, now brokerages are expecting profit to decline almost by 70 to 75%. Now this is because of the one-off impact that we saw in the last quarter and also because of the weakness in the loan book that the bank has shown for the last few quarters. When it comes to some things to watch out for, first is that the growth in net interest margin and the trajectory, how they are going to call out for the trajectory of net interest margins is something which is a key thing to watch out for. Second is that MFI asset quality, and third is the growth trajectory going ahead in terms of the asset size as well. So definitely we are watching out on IndusInd Bank, but at least for this quarter we are expecting weak set of numbers.
Okay, all right, Gaurav, got that. Thanks very much. So waiting by for IndusInd Bank's Q1 report card. Also waiting by for Gale's report card, actually. Let's go back to Sonal to get the expectations laid out. Sonal?
Well, Gale is expected to report numbers, and there will be a sequential decline in the revenues this time around of 3.3% to come in at 34,474 crore rupees. EBITDA, however, is expected to increase by 5.5%, margins at 9.8%. Profits, however, will see a decline of 3.5%. Well, let's talk about the segments first, because this time around, the transmission, petchem, LPG businesses, all of them are expected to remain weak. In fact, the losses in petchem is expected to widen this time. Kotak has put out some estimates. They expect gas transmission volumes to decline 7% YOY, but they will be up 1% sequentially. Petchem sales volumes will be flat YOY, decline 26% on a quarter-on-quarter basis. LPG sales will also be up 3.5% quarter-on-quarter, but they will be down 6% on a YOY basis. And marketing EBIT will come at 1,250 crore rupees, which will be a decline both on a quarter-on-quarter and on a YOY basis.
Thank you, Sonal, for that. Get into a break. A quick small programming note for all our viewers. As the workplace transforms, so must leadership. In the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on the 29th of July, 5:30 p.m. onwards, only on CNBC TV 18, CNBC-TV18.com and YouTube. Welcome back. Counting down to today's trading session. It's been a challenging start to the trading week. The Nifty is below 24,700. The pain is more acute in the mid and the small caps, and the advanced decline ratio is negative now for the 7th consecutive day, firmly in favor of more declining stocks, 1:3 in terms of advanced decline. Dharmesh Kant from Chola Securities is now with us. Dharmesh, afternoon. Lots of mid-caps are bucking the trend. There's Acme Solar, Sterlite Tech, Laurus Laboratories. Any of these stocks that you like, or which one has been the pick of from the earnings season in the last couple of days?
Yeah, Dr. Rima. I mean, see, earnings have been all over the places in this season around, and chemicals is one sector which, I mean, the performance has been far better than the other sectors. Cement, chemicals, metals, they have done pretty well. Today's earnings, be it Laurus Labs, I take it with a pinch of salt because the reason being earlier also the management has guided strongly, but last 3 years there have been many misses than hits on that front. And look at the valuation multiple, it's at around 92, 93 times trading PE multiple, which is, they are trading at. So to my mind, I mean, CDMO business is fine, but scaling back up to 32 kind of a margin would be difficult for that. And going by the valuation multiples, it's time to take profits. So that is the take. The earnings spec which I liked was more to do with the chemical space where things are happening. Maybe Ether Industries is one company which one should look into, which posted a good set of numbers. And in independent power producers, one should be looking into NTPC Green Energy earnings. It's due, and the capacity additions for this year would be around 5 to 6 gigawatt, sorry. And that would be entail a huge amount of profitability going forward. We have seen the proof of the pudding in the other independent energy producers, which they have given the numbers and how capacity addition helps in the earnings growth. So NTPC Green is what we are banking on. Let the earnings come through, and then further we can take a call on that.
BEL just reported numbers, and EBITDA margins and bottom line looks pretty solid. Even though on the top line, I think there's about a 7-8% miss. Dharmesh, any thoughts? Bharat Electronics?
Yeah, got from Bashar. Yeah, the numbers were okay type of numbers with better EBITDA margins. But when we are looking at defense companies, one should not be looking on quarterly basis. That is my sense. Because if you look at the 13, 14 listed companies, all put together post a revenue of around 68,000 to 70,000 odd crores. Whereas the order book stands as in excess of 3 lakh odd crores. So more, the visibility of order book is 4 to 5x, and these are basically lumpy businesses, not cyclical in nature. And there are a few years where you will have a good round of, revenue booking and profitability coming into play. So any declines out there for a company like BEL or HAL, we are recommending to acclimate on every declines, and the horizon should be 3 to 5 years kind of a perspective, because the opportunity size is very large. It will entail over a period of time. But as of now, because quarter the kind of value traders may be booking profit, and they are the ones who also carry the stock prices forward. So stay invested in both BEL and HAL. Defense looks pretty attractive to us.
What are you advising on Kotak Mahindra Bank post the numbers?
Yeah, Rima, the difficulty with the large banks and the large IT companies has been they have been very candid about the growth and trajectory and the atmosphere prevailing into the economy. And Kotak Mahindra Bank, the basic problem has been the guidance for in fact Q2, the retail and the two-wheeler, three-wheeler division, which is basically a small ticket size of loan, and they have cited that there's a problem out there. So it's still, valuation is expensive, around 2.3 times price to book value at current price. I think some more downside out there, and one has to wait for Q2 to pan out before taking a jump into financials, because it's not only Kotak Bank which has guided for a weak set of retail credit growth. It's across the board we are finding the same kind of synergy. So financials are barometer of the economy. So let's wait and see rather than jumping the gun and buying it out right now.
Okay, all right. Dharmesh, stay with us. We're going to just wrap out things here, and then we'll come back to you on markets forward. So you've got the indices all lower, varying degrees, 0.5%, about 1.25% lower. Nifty Bank, small cap, mid cap indices. But apart from that, not very much at all. So a drifty lower day. Market breadth, of course, clearly on the negative side, some 3:1, over 3:1, declines to advances on the NSE is what you had. So it was on the downside. If you look at the Nifty, it was a bunch of financials, right? So Kotak Bank and Bajaj Finance, IndusInd Bank on the Nifty were the top losers. Outside of Nifty, SBI Card was the big loser. On the large caps, the IT names were the other pack, which were lower. TCS, HCL Tech. Wipro, of course, was down about 3.5–4% as well. And of course, real estate as a pack did not help either. I think as a index, the Nifty Real Estate Index was the top loser. Lodha was down sharply, Godrej Properties, and a few more as well. So enough moving, but it was largely on the downside, continuing the downside that we've seen develop over the last couple of weeks or so. Rima.
Well, with that, it's curtains down on closing bell. But since the IT industry is in the spotlight in the new age of AI and so much business disruption, you'd want to listen in to this next show. It's our special show, Editor's Playbook, where we will discuss India's IT industry that is at a crossroad. Will the AI age force a change? Coming up next.
India's software industry is a key pillar of the economy. It accounts for nearly 10% of the GDP. Now, Indian engineers are a mainstay even in Silicon Valley. From Sundar Pichai at Google to Satya Nadella at Microsoft, Indian engineers occupy corner offices at some of the world's biggest tech companies. But the software industry seems to be at a crossroads. After a pandemic-fueled bump, growth has largely moderated. Employee strength and salaries at top IT companies have remained stagnant over the last 3 years. In fact, some have seen a reduction in the headcount. There are new opportunities and challenges in the form of automation and, of course, now generative AI. Add to that, software service providers facing more competition, with multinational companies establishing their own global capability centers, or GCCs as they're called. IT companies need to transition to new technologies while also rethinking their business models. This is the Editor's Playbook. Each week, our team of editors will put the spotlight on the most compelling events across the world and try and decode what they mean for India. I'm Shireen Bhan. With me, our band of editors, Prashant Nair, Nimesh Shah, Rima Tendulkar, Surbhi Upadhyay, and Sri Ramayar. Guys, thanks very much for joining us here on the program. For context, I want to go back to a conversation that I had in January of this year. And everyone was talking about a demand explosion. It was Infosys, Salil Parekh, Tech Mahindra, Mohit Joshi, Kriti at TCS. Everyone was talking about how they anticipated this year to be a much better year for Indian IT services because of what Trump would do with deregulation and the demand explosion that they were hoping it would unleash. But I had a conversation then with Frank D'Souza, the man who used to head Cognizant, and these were his words. He said, Indian IT companies are facing an existential crisis. Now, this is not the first time this has been said. I would imagine it's not the last time that this is going to be said either. So let's go across to our own in-house IT expert, Rima Tendulkar, to put this in context for us. Rima, to start with, is there a problem? What is the problem? And what are we talking about?
So let's, Shireen just put it in context, right? Look at the last 10 years, FY15 to FY25. And here I'm going to break it down in the last, in 3 periods, right? There is FY15 to FY20, which is pre-COVID, when IT companies were growing at 8, 10, even 12%, barring, say, a Wipro. Then you had the COVID boom. Okay, from a low base of FY21, FY22, 23, IT companies were growing at 15 to 20%. The drivers were digital transformation, there was the cloud migration, and then there were these very, high intensity, short duration projects to enable, say, a work from home or to realign the supply chain. So therefore, IT companies were booming, 15, 20% kind of a growth, perhaps even more. And then came, the after. So FY23, FY24, FY25, growth rates started tapering off, and we're talking about 2 to 4%. And this year is also going to be no different. Look at Infi. They're guiding for a 1 to 3% growth. So growth rates have literally fallen off the cliff in the last 3 years. Everyone was saying that, tech budgets are unutilized. So at some point, you're going to get that pent-up tech, boom, but that's not coming so far. So the worry now is that are the Indian IT companies in a structural slowdown? Gone are the days of an 8%, 10% kind of growth, but we could be in a low to mid-single digit kind of a growth rate over the medium term.
I mean, just look at the graphic that's coming out.
Structural slowdown. Yeah, go ahead, Sriram. I just wanted to address this issue. When Rima talks about a structural slowdown, it kind of also seems to reflect what Frank D'Souza was talking about. I mean, he used a more dire expression, an existential crisis. But is there a growth problem? Is there a business model problem? Is there a capability problem? I mean, that's what we're trying to understand here.
I think it's a mindset problem, to my mind. I mean, if you just go back a couple of months when Piyush Goyal was complaining about the lack of deep tech work, absence of deep tech work in India, a lot of people reacted, venture capitalists, startup founders, etc. Yeah. But to me, the silence of Infosys, TCS, Wipro was conspicuous. I mean, they should have been the first one to answer that question, because what does innovation require? Capital, talent. And if you have about 1 million engineers, techies working for you,
I think 10 million last count.
Exactly. I'm just saying, you can't, I mean, if each company has to put together 50 people and say that, do whatever you want. And we could have been on the forefront of innovation instead of just talking about it. I mean, I was just pointing towards the graphic that was just fired, right? One could argue that, their growth rates have fallen from 21% a couple of decades ago to now, what's the number?
2, 4, 3.
Yeah, exactly, right? I mean, the last 5 years, CAGR is 8.1%. But I'm saying one could argue that it's a base effect. But this existential crisis, Shireen, that you spoke about, like you only said, it's not the first time that somebody has said this. In the last 4 decades, we've had 3 such existential crisis moments for Indian IT. One was after the global financial crisis, when the whole world was moving from, to cloud and big data. Then you had the digital services around 2016, 2017. The cloud had taken shape. Now the SaaS had exploded all over the world. So Indian IT services had to respond to that. And then you had, now you have AI. 4 decades, 3 big shifts. And 2 lessons that are very clear to us, which is macro headwinds, whether it's political in terms of Trump presidency, Brexit, the whole movement against outsourcing that happened at the start of the 2010s. Yeah. All of this is inevitable. You can't do anything to control it. What can you do? What can you control is the money that you spend on R&D. If you don't innovate, if you're not ahead of the curve in terms of what technologies are coming up, then you will constantly play catch up. And quite honestly, to be fair to them, they have caught up also very efficiently, right? I mean, they've managed to do that. But, you can't bet on that each time. They've made a lot of money for investors, but have they built a lasting company?
And that's an important point to bring up, because, again, I was having a conversation with someone who said, and his rebuttal or response to this existential crisis thing was that, look, the same thing was said when the digital or digitization wave took place. But today, you don't even differentiate when you talk about Indian IT company revenues. You don't differentiate between digital and the rest of the pie, so to speak. So they have made that transition. But on the innovation
the point, Shireen, my point is that
everybody on board. Then I want to bring everybody on board on that and get them to respond. Does the market reward the big bets on innovation that may not play up in the short term?
The market, I think.
Who wants to go, guys?
I mean, I have some data, which is, but you know, it's not exactly answering your question, Shireen, that does the market reward, you know, continuous spending, R&D spending, you keep spending and then, you know, something sort of clicks, right? I mean, that kind of, I think that is your question. But in the US, right, and it's always been different. Indian IT services companies were always all structured at
as a services
hundreds of thousands of people. TCS is what, Rima? 6 lakh employees, right?
Yeah,
plus. So it's like a, and it was always cost arbitrage. That was the work. It was never leading technologies and building products, etc. Maybe it'll change as time goes by. So US IT has always been about products and new technologies, etc. They've been customers for Indian IT services companies. So just take a look at this. Magnificent 7 companies in the US account for about 47% of R&D spend in the S&P 500, right? 47% of the R&D spending is out of S&P 500 is these 7 companies. And guess what?
Yeah.
To the question, are they rewarded? These 7 companies are 34% of the market cap of the S&P 500.
Yeah.
Now, is that a straightforward answer? Of course, there are so many other things which go into the mix. But I just thought the data was kind of very, very stark.
So I want to bring in the R&D figure here.
Yeah.
In the last 6 years, we have spent they spend on average 1% of the revenue. So if you take FY25 revenue, it's about 6 lakh crore for the top 5 companies. I'm not going beyond it. And 1% of that is 6,000 crore. If you look at the actual number, it's about 3,500 crores. That's what they spend on R&D. And on the other hand, the investors in India have rewarded them for being consistent paymasters. They have given 1 lakh crore, these 5 companies have given 1 lakh crore as share buyback, as payment back to the shareholders. And that's what they've been rewarded for. So in terms of wealth creation, it's important to differentiate between how is the wealth created. By building a sustainable business or by short-term gains or long-term gains. And I think on that we've been sort of slightly...
In the US, by the way, buybacks are a huge thing.
Yeah.
I mean, actually, there have been studies which show that a majority of the gains in the US over the last 10 years, US stocks, has come through buybacks, not through...
that's a short-term gain.
That is, but I'm just saying as a method.
You've had activist investors, in the US pushing for buybacks, and you've had, we haven't had activist investors, but the call for buybacks here has been pretty loud as well. But, the data points to that. But,
Shireen, if I can,
back to this innovation question, just one minute. I just want to get Rima to come in here on this innovation question because, this takes me back to the time that CVK came into HCL Tech, Rima. And I remember very vividly then, he was trying to sort of push this idea of innovation along with the bread and butter kind of infrastructure business. And at that point, there was a pushback from investors. There was a pushback from the market. So I wanted to understand from your point of view, because, you look at this quarter on quarter, how do the markets perceive this?
Just one more example, Shireen, you remember when Sikka was there at, Vishal Sikka was there at Infosys in 2015.
OpenAI.
Yeah. He wanted to pledge $1 million in OpenAI and, we don't know, but I think the rumor is that the board shot it down.
OpenAI, by the way, the last valuation is $300 billion.
Yeah, so he wanted to invest. Yeah. So, it's been very hard, going back to the
I was going to make that point. Sorry, go on, please.
Just the mindset, right? That every time a company wants to get into products, because it's so different, the payback, etc., the investment, the kind of capabilities that you need, there has maybe been a pushback from, the board. So, just to wanted to give that example.
So from a market point of view, I'll just add what the market thinks of and how they take it. In India, there is still not enough patience for investors as well. You rightly pointed out what happened to Infosys, what happened to HCL Tech as well. And generally, it's a success which people like to follow, right? In India, we've not seen a big success in terms of R&D actually making big, whether it's a pharma, whether it's in IT. We haven't seen.
We have
Now
Glenmark.
we
have Glenmark now.
Now we have Glenmark.
Finally, Glenmark.
Exactly. So we just had.
Pharma. It's
Exactly. No, I'm coming to that.
decades. It's
Correct. I'm coming to that point.
But yeah, those are few.
Very few.
Like,
But it's an exception that points the route.
Glenmark is the first instance where you're seeing the fruits of 20 years of effort in R&D finally paying off.
Yeah.
Equally, if you look at Spark, the Sun Pharma Advanced Research, for 20 years they've been spending money on R&D and everything. Investors are frustrated and they've not made a single money on it, right? So even from investor point of view or from analyst point of view, there's a lot of pushback there is not much enough patience. I'll tell you a simple I'll give you today's example. Look at Infosys results. Street is happy that they've raised the lower end of the guidance from 0 to 1%. And
they're not happy that the stock is down.
The commentary is this is the best that Infosys reported among all the large cap IT companies, which is true. But
I just
happy.
I just want to make one point that, and I remember HCL Tech categorically for the use of this phrase, moving from run the business to change the business. I think they used this phrase at least a decade ago, if not earlier. But the real transition in terms of moving to change the business side of it, I think that's been missing, and that's where now there is serious disruption. Therefore, maybe the talk of existential issues because there's AI. If you don't change now...
I want to put that quote in context. Yeah. When HCL Tech used to speak about, run the business to change the business, they were talking on behalf of their clients. They were not talking for themselves. They were not changing their own business.
AI is now forcing their hand, as we speak. And I'll talk about this, but what some of the companies are doing.
Today's example, Coforge. Now they're not investing in some great R&D, but they are saying we're going to put money in to build a data center. Yeah. Stock is 8% CC growth, quarter on quarter. Strongest ever. Stock is down 8%.
No, but that's a different argument. Right? Data center could be a real estate company's business. It's not a hardcore software solutions business.
I'm saying new things, right?
But no, again, that's not a real estate company. But anyway.
No. Data center is not a real estate business.
Exactly, not a real estate play.
In fact,
it's a pure data play.
This is another misconception.
Exactly.
This is another misconception that has, especially in India. And I remember this conversation that I had last month in the Valley with Raju Vegasana of SIFI, because they're doing data centers, and he said this idea that data centers are a real estate play in India is just a complete misnomer, and we need to get away from that idea that it's in fact a real estate play, because it's nothing of the sort. But let's talk about the markets and how the markets are looking at this sector at this point in time.
So, Shireen, from a market point of view, barring few, mid-cap companies like what we spoke about, Coforge, Persistent, some of those high-growing companies are still, getting richly paid. They are almost at all-time highs, and actually investors are rewarding as well. But the problem is with the large-cap 5 IT names, right? I mean, I was just looking at the data of last 10 years. Riva spoke about various periods from 2015 to 20, then COVID, then last 3-4 years. But if you look at if you look at the 10-year period of the large 5 IT names, the numbers will shock you in terms of revenue, top line, and operating margins. Wipro in the last 10 years has given a revenue CAGR of 3.3%. The profit CAGR for Wipro is just 1% in 10 years. that's the kind of number that this large cap IT companies have thrown. Of course, they don't collapse or they don't fall much because of the cushion of dividend and buyback that they keep announcing every year and a half. So across all 4-5 IT companies, everybody's reported single-digit revenue, EBITDA and profit growth for the last 10 years in terms of CAGR. Who have done well? Again, as I said, the mid-cap IT companies have relatively outperformed in the last 10 years in terms of growth. Coforge stands out, L&T Mindtree stands out, Persistent stands out, and something like Tata Elxsi stands out. So at least these companies have reported double-digit revenue growth over the last 10 years period. Otherwise, it's been a very painful phase for this large cap IT.
And guys, sorry, I just want, and if we can bring up that graphic that has Wipro on it as well, because that's a startling number. I didn't realize that it was just 1%.
3% revenue, 3% revenue, 2% EBITDA, and 1% profit growth in 10 years.
The last 3 years, no revenue growth.
In 10,
but it's gone through. Wipro perhaps is the
lowest of the pack, the others, and they've had multiple CEO changes.
I think 3-4 CEOs in that period.
See, all these numbers includes change of CEOs, acquisitions, everything put together.
You didn't mention this in our CEO discussion.
This is the kind of...
That's why we said new hands coming in, need for fresh blood.
We do have a new hand at Wipro.
Yes.
But I'm just going by the data there that Nimesh presented, and again it takes me back to the conversations that were happening a few years ago, where the question mark was on, will mid-cap IT survive?
Yeah.
What will happen to mid-cap IT? Mid-cap IT seems to have done fine, Rima.
So again, the pivot, what Surbhi and Rima were talking about, the mid-cap IT has been able to pivot very fastly, change with the environment and do the right things.
I think there's also a matter of size, right?
Exactly.
It's a big matter of size, and even this
car around. It's very easy to move a trailer, turn a trailer, right?
With size and if with the money that all these guys have,
correct.
You can't give an excuse just because
I'm not giving an excuse. I'm saying it is a factor.
They can't pivot.
It's over-conservativeness. Maybe it's just that. It's just being very, very cautious.
Also,
and maybe
the base effect, like the growth rate in mid-cap IT looks better.
I think Prashant has a point. I think Prashant has a point there. You can't totally discount the base effect.
Yeah.
No, of course.
Like TCS is $30 billion in size, Infy is $20 billion, and these companies are $1 billion. Exactly, they're 1.5. Their aspiration for Coforge and Persistent is to get to $2 billion.
So my limited point is that yes, size, base effect does matter, but the fact that with this size, with the kind of might they have, the kind of cash they were sitting on,
correct.
None of them made an effort to pivot and go for an aggressive.
But had they invested in R&D with the huge cash balances, right? $5 billion plus for an Infy
and the human capital.
And the human capital, right? We've got the best homegrown engineering talent. But at that point, your buybacks would have come down, your dividends would have come down, and then you would have had.
That is what.
So it would have been a bit of a trade-off at that point.
It's like I want
to take back one point about what Rima said, right? It's a trade-off between share buybacks and investment in R&D. And Prashant also mentioned this, that there has been, and you also said, right, there has been outrage in the US for the amount of buybacks that were happening. But those buybacks were happening after a 12%, 15%, 20% spend on R&D. Yeah. They were not doing it at giving 1% for R&D and then doing buyback. It's a very small but a very significant difference.
And that's what the argument on size, which Prashant was also making. But again, look at the size of the Magnificent Seven, and they're growing. Look at Nvidia, and on that base.
Ruby, growth is 20 to 30%. There's very strong growth at that base.
Yeah,
which is what I'm saying. So the base argument beyond the point, does it really
that growth has happened. Surabhi, that growth comes because we woke up to AI after ChatGPT. They've been building ChatGPT.
That's precisely what I'm
and
saying.
all peers, right? So they were spending on R&D.
That TCS is a very large base and large revenue and large number of employees. So therefore, we can't innovate and think on our feet.
No, actually, the argument of size was between Indian large cap IT companies and Indian mid cap companies, right? It was easier for mid-cap companies to grow given the size. But Shireen, where...
There is a risk also for mid-cap companies. If they pivot and if that thing doesn't work out...
That particular technology,
blow up the entire company, right? So there is a risk as well with such small companies. Even from an investor point of view, if you invest in a large cap Infosys or TCS, you're safe. Yeah. Whereas you're looking for a very small niche company.
I think that safety...
that swing is very huge.
That safety moat that we talk about...
It just blows you up.
I don't think... that a safety moat is shrinking by the year, right? Every year.
I personally feel, there has to be 4 or 5 big R&D success stories in India. And I'm telling you then every investor, every company will start chasing and start putting money into
But it's
R&D.
chicken and egg, no?
It's just that
You have to put the money for that.
success has
You have
to
to,
come.
but that's,
Unfortunately, it's not come in the last 20
Guys,
years.
should we talk salaries? I think.
You know, AI is everywhere. But it's not on the top line, it's not on the bottom line, but it's there in terms of your job.
You know, Rima and I, Shireen, were asking the TCS management, and I feel I've asked it twice or thrice now. So, you know, you have 100 people to execute one project. You start using AI and you're executing for an American company, and you don't need 100 people now, you can do it with, say, 60 people, right?
Yeah.
You can go on for, say, a few quarters, you save on costs, etc. But at some point, the guy on the other side, your client is going to realize, right? You're doing a lot more, the same amount, with a lot less cost. And you've got to have to pass it on. So that is the pricing, the question, right? Is AI deflationary? It's going to be, in the context of our discussion, is AI deflationary for IT companies? And I mean, the answer has always been no, it is not. But it just...
And that's hard to argue, because no matter which report you pick up, if you talk about the maximum productivity benefits, it's the BPO sector, obviously, where everything is getting automated. And then it's software development, number 2. So, I mean, productivity benefits, depending on whose projection you're reading, between 40 to 50, 60%.
Yeah.
And somewhere these benefits, clients will want a bang for their buck. So, yeah,
They are
really
being
agree with that
passed on.
argument.
the point is that we let people, our talented people, go to the US and build great products there. And here we kept complaining that how, you know, we don't have all 90% of our engineers are not employable. Every IT CEO would have said this once, at least in the last 10 years. But pay the good guys and keep them there, na? So, Prashant, cue salaries.
You know, this is very interesting data. I checked, by the way. This is out of memory in the year 2003, 2004. I mean, when I started working, you had an entry-level college graduate was getting paid about 25,000 rupees a month.
3.5 lakhs.
3 lakhs. Basically, it's about 25. Yeah, roughly that, right? Now, the entry level, I am told, is about 3.6, 3.7 odd lakhs, entry level, out of college.
Yeah.
You adjust for 6% CPI inflation. Inflation adjusted in real terms, you can put the numbers in. You're basically looking at about it's actually over 70%. But roughly 65 to 70% drop in real income over a 25-year period. Almost 25-year period.
I asked the same question to the Infosys CHRO at that time. I think it was 2019. So, and I was like 3.5 lakhs, and now we are 15 years, 20 years later, we're talking about the same number. You know, what explains this? Oh, then same question, same answer, upskilling. We will train you, we'll make you better, and in 2 years your salary will be double.
Media के लिए भी बोल सकते हैं.
Skill achieve better. Let me not say anything.
AI upskilling.
Not much has changed. Not much has changed.
Exactly.
Ours is a very low skill job.
Which is why I was keeping quiet. Let me not get into it.
They may turn around and say, so why are you talking?
No, but
I know, that'll be a whole other conversation. That'll be a whole other conversation.
I guess, folks, I mean, but Shireen, don't you think it's a real question? Because from employing thousands and millions of employees at very low salaries, the model seems to be shifting to lesser but far more upskilled people at higher salary points.
That is exactly, and I think that is something that, you know, and that's a challenge not just for these companies, but that's a challenge for the larger economy as well. Because remember, this is a sector that's been an employment, generator, and now if you're talking about low code, no code environment and moving very quickly, I mean, that's not 5 years on, that's happening now. You know, CEOs are almost bragging about the fact that, oh, so much of our code is now being generated by AI, 30%, 40%, 50%. It's almost as if they're in a race with the other guy to say, you know, maximum amount of...
No, absolutely. In fact, I share that worry with Lata ma'am almost on a weekly basis. I mean, the 90s IT revolution that built the middle class of India. I mean, we're talking about a bigger change than perhaps in the coming years.
But there is one counterpoint to this. One counterpoint to this, which is that I think from the client's POV, like the people who are going to pay TCS and Infosys and HCL Techs, I think they'll be willing to pay a bigger amount. I think what they are asking is, yes, do it with fewer people, etc. There is no premium on that anymore. Just because you can do it, if you can give me a great product, a great solution. So everybody called the death of the SaaS products as a whole, right? Like outside in the world, everywhere else outside India, SaaS is dead according to them, according to many critics. Then what they are starting to ask is service as a software, like just flip it on its head. Add an AI layer to it. Add add decision making to it.
This is an AI specialist who I met in the Valley, and he's the father of many things AI, and he said the machine will not have the ability to ask questions. It may have the ability to answer all kinds of questions, but it won't have the ability to ask questions. So perhaps that is what we're going to be. What is your question?
Richard Baldwin, Globotics Upheaval. It's the book where he says the only way to beat the machine is to be more human.
Guys, it's been fun chatting with you. Unfortunately, we are out of time on this one, not out of ideas. So we'll be back again with the editor's playbook from Nimesh, Prashant, Surbhi, Reema and Sriram. Thanks very much for joining us. We'll see you again next week. Till then, goodbye.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Layoffs at TCS spark fear across Indian IT. Stocks decline across the board after TCS announces more than 12,000 job cuts in what is the biggest layoff in the software industry yet. TCS claims the job cuts are not linked to artificial intelligence and blames a mismatch in skills. US and Europe agree on a trade deal with days to go for the August deadline. US will impose a 15% tariff instead of the 30% proposed earlier. Auto tariffs reduced from 25% to 15%. Steel tariffs to continue at 50%. Business leaders in Europe criticize the deal. European Commission's president says this is the biggest deal they could get. India evaluates its options as the August deadline approaches with an interim trade deal almost ruled out. Sources say India is considering all options, including the possible imposition of reciprocal tariffs, hope to find consensus on a full agreement by fall. Sensex and Nifty near a 2-month low after a sharp fall on Dalal Street. IT and bank stocks lead the decline. No respite for mid-caps and small caps as the sell-off continues. Shares of Kotak Mahindra Bank plunge after a disappointing Q1. ICICI Bank emerges as a top performer among private banks this quarter. HDFC Bank is largely steady. Axis, Kotak and IndusInd Bank face some headwinds. Defence Minister Rajnath Singh says no important military asset was damaged during Operation Sindoor as Parliament kicks off a debate. Minister also says the operation was stopped after objectives were achieved and not under any external pressure. The union government is likely to launch the revamped central KYC registry from March 2026 instead of 2025. Government officials say that each KYC record covering individuals and entities will be assigned a confidence score based on the strength, validity, usage and revalidation of identity documents. Finance Minister Nirmala Sitharaman questions India's private sector over the lack of capital expansion, asks why is the industry sitting on passive funds instead of investing in growth. Supreme Court refuses to stop the publication of the Election Commission's draft voter list for Bihar on the 1st of August, nudges the EC once again to accept Aadhaar and voter ID cards to verify voters as many fear lakhs of voters could be disenfranchised. Maharashtra government culls more than 26 lakh beneficiaries from the monthly stipend scheme for women. This after 17 lakh beneficiaries were removed in April. The state government had credited the Ladki Behan scheme as a key reason for its return to power. More people starved to death in Gaza, even as Israel allows a temporary pause in military action to allow food assistance. The overall death toll in Gaza nears 60,000 in the 21 months of the war with Israel. Elon Musk confirms Tesla has signed a $16.5 billion chip contract with Samsung. The South Korean giant mentions July 26th as the effective start date of the contract in its filing, but does not mention the name of the counterparty. The contract is effective till December 2033. The big story we are tracking this evening: Tata Consultancy Services has said it will fire 2% of its total workforce, equating to roughly 12,000 employees over the course of the current financial year. This is Indian IT's biggest layoff exercise till date. The company had laid off more than 3,000 employees, equating to 1% of its total employee count in FY15. Shares of the firm tanked in trade in response to this development. Reema Tendulkar is here with all the details. Reema.
Thanks so much for that. So the big question is, do the job cuts at TCS signal a big tech reset? Well, the news is that India's largest IT services firm, TCS, is letting go of 2% of its workforce. That is nearly 12,000 employees. And this is largely the mid to senior level, and it would be spread across FY26. Now, this is significant because TCS is the bellwether of India's $250 billion IT industry. Job losses at this scale are not just rare for TCS, they're unprecedented. So what is the key driver behind the job cuts? Well, it is a growing mismatch between demand and the available skills. TCS insists this is not about AI replacing jobs or the need to hire less. CEO K. Krithivasan told Money Control that this is not about AI giving you 20% more productivity gains. It is about skill mismatches and the feasibility of deployment. But that said, there has been a slowdown. There has been pressure on margins, and in an AI automation world, we need fewer people. Fewer managers will be needed. The mantra is basically you can do more with less. Now, global tech giants have already made very deep workforce cuts, and this has been happening for a while. Just this year, Microsoft has axed nearly 15,000 jobs in 2 rounds. IBM has reportedly let go of 8,000 employees as AI has replaced HR. But now what's happening is that the tech layoff wave is hitting closer home. TCS calls it as a part of a journey to become a future-ready organization. But the deeper shift is clear, that the traditional, people-led, a linear revenue model is now giving way to an outcome-based AI one, a platform one. And it hasn't happened overnight. Indian IT companies have been stealthily, quietly rebalancing their headcount for nearly 2 years. This is the picture over the last 2 years and how the headcount has changed. For TCS, it's lower by more than 2,000. For Infy, about 12,500. Wipro, in excess of 25,000. So the question is, what lies ahead? Will other IT companies also follow suit and optimize their workforce to become future-ready? So do we have more job cuts coming for the entire sector? Will the industry continue to delay wage hikes? Remember, TCS hasn't given their wage hike as they normally do in April. And in the near term, say for a company like TCS, will this trigger a spike in attrition, or will it in any way impact the job delivery? So lots of questions. We'll have to see how this plays out. But this could just be the start of a deeper transformation in the Indian IT, the way it operates and survives in this age of AI.
Right. Thank you, Reema, for that. The employee strength of IT majors have also remained largely stagnant in every fiscal since FY23. In fact, TCS and Wipro have seen a reduction in headcount, while employee strength has improved for Infosys. This as companies reduced hiring after stocking up on talent during COVID. Furthermore, growth has largely moderated after a pandemic-fueled surge, with constant currency revenue growth even falling quarter on quarter in the case TCS and Wipro in the first quarter of the fiscal. Now, software service providers are also facing more competition, with multinational companies establishing their own global capability centers for GCCs.
The focus on the Sholay dialogue, kitne aadmi the, or headcount based judging the IT industry, I think, thank God that period will be over.
So I tend to agree with the TCS narrative that this is a future-oriented restructuring, because in the days of generative AI, when you're using ChatGPT a little bit and helping yourself, that was fine. But this is the day of autonomous agentic AI, which means that 80% of the work could potentially be performed autonomously. So in that context, when you look at your organization top to middle to bottom, then you do a fundamental rethink. And I think every industry, I mean, it does not just IT, but definitely including IT, will do this reorientation. There will be some shedding of jobs.
Seems that it is not AI related, and that is how I would interpret it as well. Because if had it been AI related, you would have seen more jobs being cut at the lower end of the org structure. So it probably is just a bit of being more efficient and optimizing the organization.
The big global story we are tracking. The United States and the European Union have reached a trade deal after 4 months of negotiations. President Donald Trump, flanked by European Commission President Ursula von der Leyen, announced the deal at his golf course resort in Scotland's Turnberry. US President Donald Trump has said that the country would impose a baseline tariff of 15% on most European goods, including cars. Further, EU has agreed to buy energy products worth $750 billion from the US and invest additional $600 billion in the country. However, US is expected to keep 50% tariff rate on steel and aluminium. However, Europe remains divided over its response to the deal. While German Chancellor and Italian Prime Minister welcomed the trade deal, French President hinted that it was a dark day for the Union. German exporters remain wary over the deal as well. They feel it could have negative repercussions. European Commission's president says this is the best deal they could get.
We have good news. We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries, because, as you know, Ursula represents a lot of countries, not one country. It's not easy for you. It's because a lot of very different countries, great countries, but some are strong with cars, some are strong with agriculture, some are strong with both, right?
15% is not to be underestimated, but it is the best we could get. It's overall across the board. Important was for us, it includes not only the cars, so go down with the tariffs for cars to 15%, but also all goods and semiconductor and pharma.
Moving on, the United States and China are set to resume a fresh round of talks for an extension of the trade war truce between the two nations. Treasury Secretary Scott Bessent and China's Vice Premier will meet in Sweden's Stockholm to restart negotiations. The current 90-day truce between the US and China is set to end on 12th of August. US Commerce Secretary has said that Washington's August 1st deadline for imposing tariffs will not be extended. Speaking to Fox News Sunday, he said that the US president is willing to continue negotiations even after the tariffs kick in. However, he maintained that no country will be given a grace period. And speaking of trade deals, the United States has managed to secure agreements with most of its biggest trading partners. China, Japan and the European Union are Washington's top trading partners and have achieved trade deals in the tariff range of 10 to 30%. Similarly, 3 countries of the South Asia region, Vietnam, Indonesia and the Philippines have also reached trade pacts with the US. However, other countries of South Asia, including India, have not been able to finalize a trade deal and are facing a proposed tariff rate in the range of 25 to 36% ahead of the August 1st deadline. And speaking of striking a trade deal with India, sources have said that with only 4 days to go before the August 1st deadline, there have been no signs of a breakthrough on trade deal yet. Parikshit Luthra joins us now. Parikshit, with no breakthrough in sight, what does this mean for both the countries?
Well, it looks like it's going to be difficult to have any sort of interim deal before the 1st of August deadline. Sources telling us there is really no breakthrough in talks since the 18th of July. That's when the 5th round of talks between India and US ended in Washington, D.C. Since then, we've not really reached a point where we could say that both sides can have an interim deal with the issues that have been agreed upon till now. What seems to be the case is that Donald Trump and the United States want a bigger, more ambitious deal. We have seen the kind of deals he has struck with Vietnam, Indonesia, also the European Union and Japan. Many of these deals are one-sided, with the US getting unprecedented zero-duty access in these markets, but in turn it is imposing 15 to 20% tariffs. That's not acceptable to India. India wants the tariff arrangement to be equal and reciprocal. Secondly, US has also got major big-ticket investment commitments from companies like Japan and Indonesia. With Japan, almost $550 billion worth of investment commitments. Now, many experts would say these are not binding, but at least on paper, those announcements are definitely there. Can India give in to such commitments? At this stage, it seems we're not ready to make such big-ticket announcements for the US. There are definitely energy purchases, defense purchases in the pipeline, but not to the extent of what is being committed to, or what he's claiming to be commitments from Japan, Vietnam and Indonesia as well. So let's see what happens. While both sides are not ruling out any interim understanding, any deal looks difficult as of now, but post the 1st of August, discussions on the larger bilateral trade agreement by fall would continue. In fact, a US negotiating team is coming here in the month of August to see if there can be some sort of breakthrough in talks.
All right, thank you, Parikshit, for that. On that note, we will slip into a short break. Coming up next, Defence Minister Rajnath Singh says no important military asset was damaged during Operation Sindoor as Parliament kicks off a debate. Welcome back. On to the day's market action now. The market fell for the third straight session, ending nearly at a 2-month low. IT and bank stocks led the decline. Large cap IT stocks witnessed a broad-based fall after TCS's job cut announcement. Kotak Mahindra Bank erased its market cap of over 30,000 crore rupees after reporting weak earnings. The Finance Ministry has said that India's inflation in FY26 could be lower than the Reserve Bank's projection of 3.7%. In its economic report for June, the ministry said that this creates room for the easing cycle to be sustained. However, the report flagged that the slowdown in the United States could dampen further demand for Indian exports. The government has plans to roll out central KYC framework by March 2026. This is slightly later than the original deadline of 2025. The new KYC rules will introduce a risk-based and confidence-scored system. Sapna Das joins us now with more. Sapna, take us through the new rules.
Well, this has been in the pipeline very clearly. So instead of the current calendar year of 2025, we are given to understand that probably we have March 2026. The central KYC registry should be ready to roll out this revamped KYC process, or rather the framework, so to speak. Now, if you recall, the finance minister in her budget speech had also alluded to the same. She had said that in the current year, this is going to roll out. Plus, it's also going to help in periodic updation of KYC records. So having said that, 3-4 important elements that will be brought out from March 2026 in support of customers and regulated entities, which we should be aware about. First, of course, the confidence score. This is the first that's going to happen in terms of your KYC data. So, it will be kind of categorized on 4 counts: basic, compliant, enhanced and assured. So the higher your confidence score, the better it is for you as well as for the regulated entities. How will this help in the times to come? Well, every time when there is a re-verification of KYC documents, if you're in the highest confidence scoring category, it may just be possible that your re-verification will be relaxed by the concerned regulated entities. That's one aspect. The second, of course, is also in terms of risk. Basically, the re-verification process. Again, what I was talking about, the updation of records, that's going to be far more streamlined. We are given to understand, for instance, if as of today, every 10 years, your KYC documents are kind of re-verified. But today, for instance, if you have a PAN which is updated, so starting from that particular date, your next re-verification will happen. So, to that extent, it's going to be very beneficial for the customers. Also, all your data is going to be there in a streamlined fashion on the registry. So, any regulated entity that wants to check on your records, instead of asking you, can actually access that database directly. That's second. Third, of course, we also given to understand, last but important, we also given to understand that there will be also risk-based KYC in the sense that low, medium and high risk. Now, this is being done to basically, check and prevent money laundering.
All right.
So on that count also, there are certain criteria that are going to be introduced.
All right. Thank you, Sapna, for that comprehensive update. Shifting focus now, the monsoon session of Parliament session resumed today with Defence Minister Rajnath Singh leading a debate on India's Operation Sindoor against Pakistan. The Defence Minister rejected allegations that the operation was halted due to external pressure. He clarified that it was only paused after India achieved its political and military objectives. When questioned on the number of Indian jets lost during the operation, Rajnath Singh slammed the opposition and said that the result is what matters. He reiterated that Operation Sindoor was a clear military success.
कभी कभी हमारे प्रतिपक्ष के लोग ये पूछते रहे हैं कि हमारे कितने विमान गिरे। मुझे लगता है उनका यह प्रश्न हमारी राष्ट्रीय जनभावनाओं का सही से प्रतिनिधित्व नहीं कर रहा है। मुझे लगता है उन्होंने एक बार भी हमसे यह नहीं पूछा कि हमारी सेनाओं ने दुश्मन के कितने विमान मार गिराए। आपको प्रश्न पूछना है तो यह प्रश्न पूछिए, क्या ऑपरेशन सिंदूर सफल रहा? तो उसका उत्तर है हाँ।
देश ये भी जानना चाहता है, वे 26 लोग जो जिनके परिवारों में आज कोई गुजर गया, वे ये भी जानना चाहता है कि 100 दिन गुजर गए और वे 5 दहशतगर्दियों को ये सरकार पकड़ नहीं पाई।
At least 3 terrorists have been killed in an ongoing encounter in Srinagar's Dara district. The operation has been codenamed Operation Mahadev. A joint team of police, army and the CRPF launched search operations in Lidwas this morning. Officials said that there were reports of terrorist movement in the area. The army has clarified that the operation is still ongoing. The Union government has said that Elon Musk-backed Starlink will offer services at around 3,000 rupees a month in India. Chandrasekhar Pemasani, the Minister of State for Telecom, told CNBC-TV18 that Starlink's India entry will not be a risk to existing telecom players. The company's capacity is also to provide only around 20 lakh connections in India. The Maharashtra government has culled more than 26 lakh beneficiaries from the monthly stipend scheme for women. This after 17 lakh beneficiaries were removed in April. Santya Gora is here with more. Santya.
Right. So in a significant development, Maharashtra's BJP-led Mahayuti government has slashed 26 lakh 34,000 beneficiaries from its flagship Mukhyamantri Mazi Ladki Bahin Yojana. The state government claims that these beneficiaries were ineligible for the scheme. Now, why were they ineligible? According to state government, they were either availing benefits under multiple schemes or multiple members of a single family were getting the cash handout. In fact, in some cases, even men had enrolled and they were receiving money under the scheme. The important part is that these 26.3 lakh ineligible beneficiaries were slashed from the beneficiaries list after having received 1,500 rupees every month for all these months. Women and Child Development Minister Aditi Tatkare said that regarding action against those who fraudulently enrolled in the scheme, the state government will take a suitable decision. So whether or not an action will be taken, that remains to be seen. Also, this is not the first time that ineligible beneficiaries have been found availing benefits under the scheme. In April 2025, benefits for 8 lakh beneficiaries were reduced to 500 rupees per month, citing that they were already receiving stipends of up to 1,000 rupees per month from other schemes. That same month, 17 lakh beneficiaries were removed from the list. In June 2025, 2,200 government employees were found availing benefits and were subsequently removed from the list. In July, 14,000 men were found receiving benefits under the scheme, a scheme which is purely meant for women. And now, 26.34 lakh ineligible beneficiaries have been removed. The scheme was launched in July 2024, just months before the Maharashtra Assembly elections. Before the elections, the total number of beneficiaries under the scheme was 2 crore 63 lakh. Since then, 43 lakh beneficiaries, including these 26.34 lakh, have been removed, but only after they had received 1,500 rupees per month for several months. This has attracted criticism from the opposition, which is calling this a criminal waste of taxpayers' money. The opposition claims the government allowed these ineligible beneficiaries to avail benefits for electoral gains.
All right, thank you, Santya, for that. Shifting focus now, 19-year-old Divya Deshmukh has won the 2025 FIDE Women's World Cup in Georgia. Deshmukh beat veteran Grandmaster Koneru Hampi in the second rapid tiebreak with the black pieces. With this, the teenager has etched her name in history as India's 88th Grandmaster and only the 4th Indian woman to achieve the prestigious title. All right, with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Well, hello and welcome to Finding Alpha, the show where we zoom out to understand the macro and then deep dive into the micro. All of this to sharpen your stock selection process. Well, today we'll be focusing on a very, very crucial theme. Who stands to gain amid the rate cuts and asset quality concerns? With the RBI shifting to a pro-growth stance and introducing a series of rate cuts, albeit modest, investors are weighing this against tepid credit growth and some signs of emerging stress in asset quality. Well, to unpack this, we're now joined by Digant Harya, founder of Green Edge Wealth, a firm that builds tailored stock and high-yield bond yield portfolios. Digant, by the way, has been tracking India's banking and NBFC space for over 16 years and brings a sharp lens to what matters and what doesn't in this dynamic sector. Well, Digant, thanks a lot for coming down to the studio. And we're looking forward to learning more about, the financial companies, NBFCs and some HFCs as well. How are you feeling about the sectors right now?
Thanks, Nigel. Pleasure to be here. Pleasure to be on the first show of, the first episode of this new series. So yeah, I think, banks, NBFCs, it's a very large sector. So always there's interest. And the reason for a higher, a higher scrutiny for this sector now for investors is, the RBI started reducing the regulations and they have cut the rates. Yeah. And there's a finance minister who said that NBFCs should not think of themselves as shadow banking and they should now go out and grow. So the government and the regulator wants this sector to grow. Which is the reason why we are all looking very closely where in the large space can we find our growth.
All right, Digant, then let's take that forward and let's focus first on the housing finance companies, because it's more relatable as well. Now, housing finance companies within that, some of them could see some margin expansion, as you said, because of the rate cuts. Lower cost of funds will help them. There is also backed by physical assets, which is good in terms of asset quality. And within housing finance companies, well, we'll break it down into traditional housing finance companies and affordable housing finance companies. First on the traditional lot, and we'll get those graphics up for you on the screen, the likes of LSE, Housing Finance and the likes. Yeah. Anything you like out there? Is there one of those companies that is better placed?
Nigel, I think, traditional housing finance companies, you highlighted a lot of positives, but then, all these positives come with very high competition. All private banks, all PSU banks, all regional banks, everybody wants to do affordable housing, and which is why the margins and growth both will be under pressure for this segment. So this is a segment which is best left for, somebody who's happy with 10% returns, because I don't see, a big upside in any of the stocks in this particular sector. I think if somebody is still very keen, maybe Canfin Homes has a little bit of turnaround story left, but otherwise I think best to focus on smaller names, niche names where banks cannot really come and compete.
So we'll keep the traditional housing finance. They're not giving you anything to really be very excited about. But let's focus on, the other ones. That's the affordable housing finance companies. And when we talk about real estate companies, their advice is always go with the larger names. But I believe from this space, you are looking actually a smaller name from the affordable housing finance. India Shelter, that's the one that's on your radar. I think it's well placed, though the loan book is the smallest, but the ROA is looking quite good. Tell us more and what's the rationale?
Yeah, so I think, the affordable housing story of India, a lot of times we say there's so much opportunity. Actually, that's not true. The opportunity is limited in affordable housing because all the housing prices have gone up. So in housing finance, we have one rule, Nigel, that you focus on companies which are small in size, because the moment you hit 20-25,000 crores in loan book is the moment where either your growth or your asset quality starts suffering. We have seen that with Gru in 2016, Canfin in 2018. These were also great affordable companies at one point in time and they're struggling later on. We've now seen it with Awas and some extent Aadhar also. So this is a space where I think smaller is beautiful. And I think amongst the small space, there's Aptus and there is India Shelter, which is like less than 10,000. Between the two, I think India Shelter has a better growth focus and better prospects of growing and maintaining their profitability. So I think that can be a business which can do well over next 18 months.
Yeah, and as you said, I think the loan book is less than 10,000 crores out there, but it gives you a good potential to grow. Just wanted you to highlight, what about the LAP exposure for these companies? How much is it?
Okay, so that is slightly, like we say these are housing finance companies, but anywhere between 25 to 40% of their portfolio is in loan against property or LAP, as we say. It's a slightly risky segment, but that is what gives them margins. These players over the years have really done it well, but there's a little bit of risk build-up. So, you always have to be careful and not go overboard because, mind you, Nigel, these are all trading at 3.5 times price to book also. So they need to execute well. I think India Shelter over last 2 years, they have had a new management from Chola and I think they're doing things right. So I think that is where we have the best probability of success. But yeah, we have to be careful about LAP.
Pick of the pack, India Shelter from Digant there. Loan book size relatively smaller, but they've got triggers. And that's why Digant says that they're favorably placed. Digant, I wanted to ask you about the asset quality. On the asset quality side, particularly in various pockets, MSME, 2- and 3-wheeler space, there are suddenly some signs of some pressure. Right. For the sector on the whole, how are you reading it?
Yeah, so see, I think the pressure is in the high-yield lending space. Like if we break down the entire lending space, the pressure is in the high-yield lending space. So you look at microfinance, you look at personal loans, you look at unsecured business loans, and lastly, you look at these 2-wheeler, 3-wheeler loans. So these are all places where you lend at more than 20%. There is a stress. The stress is not come today. It is building up since the last 18 months. Yeah. I think another 6 months and we will find our feet. So it's not something which is alarming to me. I think we have already seen bad patches. We are about to, end those bad patches in coming quarters.
Yeah, that's heartening to hear because let's turn our attention then on the vehicle finance companies itself. And, from that space, HDB Financial, well, it recently listed. And those that bought in the pre-IPO would be a little bit worried, because the IPO came actually attractively priced. Right. Now, going at the current state of affairs and, the valuations that it trades at, what's your view on this name, HDB Financial? If you compare it with the traditional darling, that was Chola, always got the best in terms of valuations. Right. Out there, between the two, good pedigree, good parentage, what's your pick? How would you approach both these two names?
Yeah, I think, see, Chola, there is very little to complain, but the macro setup is really we were at the best possible scenario for the last 3 years. Good truck prices, good number of trips. So everything was going good. I think after 3 good years, we have a high base and, we are slowly decelerating. So somebody like Chola, who has seen amazing valuation expansion, amazing returns, I think that should rest now. The best days for Chola as a stock, maybe 1 year is a time of consolidation for Chola, maybe even a little bit of correction because it has run ahead in terms of valuations, around 5.5 times price to book. HDB Financial, on the other end, it has struggled over the last 2 years in terms of asset quality and operating costs. But I think if cycle improves, which is our thesis of this show, that, the lending cycle will improve in the next 4 quarters, I think HDB Financial can meaningfully outperform Chola. Not to say that, these are like small caps who can go up a lot and something like that. But between the two, I think the funds may actually end up shifting from Chola to HDB if HDB shows a little bit of execution. All right. So, and HDB is much more cheaper. So
absolutely, as that chart is telling you, HDB is still relatively more attractive priced if you look at it against Chola. So we take that on board. And in the near term, you would say, if someone is looking at a fresh investment, you'd rather pick HDB over Chola for the reasons that you've given. What about Shriram Finance? It was attractive. Then it became even more attractive, made its way into the Nifty, and it's a frontline name. Valuation cushion, but what is your view on the stock?
I think Shriram has also done really well. If you look at last 3 years, it's done better than Chola also, which will come as a surprise to a lot of the observers of this space. But I think, Shriram should also rest. Just like Chola, I think Shriram should also rest for some more time. Their numbers, we are at 3.5% ROA. So, when you are at a high base and the environment is not very favorable, you may not show very strong earnings growth, and stocks typically don't do well. It's a great business model, great company. But I think, you will get better opportunities after 6 months or 9 months.
Okay, let's talk about then. So Shriram, Chola, maybe a bit of a rest. HDB Financial is something that could relatively better place. But let's talk about a stock actually that's done very, very well. L&T Finance, the stock is up, I think, close to 50% in just the last 8 months or so. It's re-rated a fair bit. But since Mr. Sudipta Roy, since the time he took over, there's been a lot of good news that's coming in there. And we just spoke to them actually. They said that they'll grow by 20-25%. That's good. But they only cautioned that the MFI industry, that recovery could be pushed back by a quarter. Your view on the stock, it's already seen some part of re-rating. Is it getting started, or is the best already in the price?
Okay, so see, they had this turnaround 3 years back when the new CEO joined. He changed the way credit is done, especially in two-wheelers and tractors. So I think that turnaround will be visible, from say next quarter or Diwali. And microfinance, as we say, is a pain for everyone.
Yes.
But if you look at the comparative charts, the pain for L&T Finance, Ujjivan, and Credit Access, these three companies, it has been the least. Like, so they have been the best three out of the 40 microfinance companies. So I would think that this is one place where you have a large name, comfortable valuations and good potential, combination of all three. So if somebody is looking at the larger blue-blooded names between, say, Shriram, Chola, Sundaram, Mahindra Finance, L&T, I think L&T is a hands down, can be a better performer than the other large names.
But the only point is, after the recent run, it's not that cheap compared to what it was. That said, what would the fair multiple you would give it, for L&T Finance?
So see, L&T Finance, all other diversified large groups, who have corporate backing, they're trading at 3 to 5 times price to book. This guy is at 2 times.
Yeah.
Obviously, it is because the ROEs are at 11-12%. I think as the ROEs re-rate, which they should over next 18 months, I think the valuations also have room to expand. So you have a 20% room to expand in terms of valuations, and then earnings compounding is what people can earn. And in absence of all other ideas, a lot of money can flow. So valuation expansion can be a bigger game as well, which we cannot predict today. But if Sundaram, Shriram, Chola, do not attract money, the money is going to flow somewhere else.
Well, Digant, so that's about the vehicle space, vehicle financing space. But I think the space that gives you some comfort is with the way gold prices have moved up. These gold finance companies actually could be pretty well placed. And also the commentary that's coming from the RBI, particularly in the last, I think, 10 to 12 months, has been favorable. That said, just give us a couple of basic numbers first. What is the size of the opportunity out there? How much of it is unorganized? How much of it is organized? The split between organized and unorganized?
Okay, so see, credit card, people like us, we get credit cards. We can just go and swipe whenever we want. Gold loan is sort of, a credit card for the businessmen and credit card for the poor. Like, whenever you need emergency loans, you pledge your gold, you get the loans. It is no more a distress loan in India. It's not as if when I don't have anything and there's emergency. So it's like a business loan. So instead of playing a personal loan company or a business loan company, gold loan is a preferred bet. That the overall industry is very huge. More than 15 lakh crores is the total industry size. But half of it is controlled by money lenders. Money lenders charge 36 to 40% interest rates. And it is almost criminal. Those rates are so high that, I think these NBFCs charge between 14 to 19%. So they have a very good case. The banks generally charge between 12 to 16%.
Okay.
So that is the spectrum. I think this is an industry which is growing because, one, gold price is extremely favorable. 2, the regulator has streamlined the guidelines, and the guidelines are actually in favor of the sector growing faster. And 3, you have more and more players who are coming in the gold loan industry, like Poonawalla is starting with 400 branches, L&T Finance acquired Paul Merchants, and so on and so forth. So when everybody markets gold loan, the industry itself expands.
Okay.
And when personal loans and microfinance loans are not easy to get, gold loans is something which shines.
And this 15 lakh crore, as you said, it's divided into 50% each of them.
Organized and unorganized.
So for the industry, what kind of growth rate are you working with for the organized sector?
So Nigel, I think these numbers may sound insane, but 20% is a bare minimum growth in gold loan industry, which we can see this year. That is when our credit growth is going to be 9-10%. So it will grow 2x that of the system. And because of all the 3 factors which I just highlighted before. One factor which every investor has to keep in mind is you have to keep your eye on gold price. If there's a big crash in gold price, then gold loan companies cannot do well for 6 months. That is a patthar ki lakir, or what do you have to say? It's a very big thumb rule.
Okay, all right. Muthoot, that's been the big daddy, right? It's always enjoyed those premium multiples in the space. But that's what could limit the upside. Instead of Muthoot, would you rather play the other ones that can now twinkle? Say a Manappuram that's got new ownership, or an IFL that's coming out of a ban. Yeah. So among these 3 names, at least, what do you like?
So I think there's a spectrum. Each kind of investor can pick what they want. Muthoot Finance will probably do the best because it is best suited to capture all the growth. But Muthoot Finance probably more for the large funds, for people who are happy with 15-20% kind of returns. For people who want to play a recovery trade, I think IIFL has a wonderful gold loan book. They will show you the sharpest upsurge in growth because they had an RBI ban and so on. And there's one more interesting company called FedFina, which is a subsidiary of Federal Bank. I think that is something which got listed a year back. slightly undiscovered by the market. And, to your surprise, in gold loans, we look at what is your per branch AUM. So Muthoot is number 1 with 21 crores of gold per AUM. Number 2 is Fedfina. It is not Manappuram. It is not IIFL. Number 2 is actually Fedfina. So, Fedfina, IIFL are interesting. Manappuram, the new CEO is about to join. They have some more pain in the microfinance. So, maybe I'll wait for a quarter or so for it to settle and then we can move ahead. But these gold loan companies are really better placed than the personal loans, companies like say Bajaj, Poonawalla section, which will come to the next.
All right. So in terms of preference, maybe Muthoot will not shine as much from now on. It could be a compounder though from here on. But the delta could come in from companies like Fedfina and IIFL as well as a Manappuram. Well, you spoke about some of those consumer-facing finance companies. I'll tell you what. We'll slip into a short break. We'll come back and we'll continue the discussion. Digant will tell us what's his view on a few of those names as well. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha on CNBC-TV18. Well, we're still in conversation with Digant Haria. Digant, we have discussed a few themes, but as promised, we're going to be moving now to the diversified consumer lenders. Bajaj Finance, that's been the poster boy, right? If you ask anyone in 15 years, where did you make your money? They would say Bajaj Finance. The problem is now that the numbers, even when they're good, people want more. Ye dil mange more, right?
Yeah.
Do you think Bajaj Finance has run its course? Or can it give, I don't know, maybe a mid-teens, double-digit returns from here on?
I think it has run its course. It's very, it's a very harsh statement to make, but I really think that it has run its course. If you look at last 9 years, the stock price CAGR of Muthoot Finance has been higher than Bajaj Finance. A lot of people don't know this, but this is the reality. See, Bajaj was a leader in physical world, buy now, pay later. You go to a shop, buy a TV, buy this. Now shopping has moved online and Bajaj is no more the leader there. So Bajaj, the main reason why Bajaj is struggling is it is no more a leader in any fastest growing segments. So Bajaj has been moving to different segments like gold loan, micro loan, tractor loan, everything which is traditional. Bajaj never did traditional stuff.
Yeah.
But now because they are not able to grow, I think they have reached a size that unless India's middle class and lower middle class does well, Bajaj cannot really outperform. So Bajaj's outperformance is now so much linked to what happens to the entire middle class. It can no more outperform the country in a big way. So I think we can, personal loans, MSME loans, two-wheeler loans, the credit card loans, they're all struggling. And, which is why, apart from Bajaj Finance, we should also be very cautious on companies like, say, SBI Cards or companies like Poonawalla FinCorp, which are talking of very fast growth in such an environment. I think these are places where investors will have to wait a lot before they can see returns.
All right, so Bajaj Finance and Poonawalla FinCorp, for the time being, you would not be, looking to jump into it. But I want to ask you about SBI Cards, because that's the only listed credit card player, right? Credit costs remain elevated. Every time, there is something or the other, and now the best is yet to come, it doesn't come. Even, the past quarters numbers haven't been that impressive. So asset quality is an issue, credit costs go up, growth is not coming about, they're not making any big dent in any market share. What's your view on the stock? Because if you look at rank underperformers, this is one stock that comes to your list.
I'll just give you one line, Nigel, that in credit cards, if you want to make money, you cannot sell credit cards at petrol pumps, at malls, at railway stations. If you do it this way, you invite a customer segment which is not very strong, and which is why your asset quality issues never end. So 2021 to 23, their sourcing strategy itself was, you go much lower down the pyramid. And which is why you see quarter after quarter losses come and management is clueless.
Okay, all right. So that's aside. But JM Financial, that's something that you've liked. What's it? What's happening out here? Does it have more legs?
Yeah, so it's a capital market play. And if you look at this stock, 2008, the price was same as it is today. So it's almost 16 years. The company went through a lot of pain in the NBFC space. They have come out of that pain. So I think good times for the company are just about starting. It will be a very interesting capital market play to track for the next 2 years, because it's like a long 7-8 year of pain which is coming to an end. And capital markets division is doing very well. So instead of a mutual fund stock or a broking stock, we prefer something like a JM Financial where, there is a lot more steam in the business.
And it's got valuation comfort as well, even after this big run. So that's something that you like.
Absolutely.
All right, let's wind this down then by turning our attention to the micro lenders. Companies like Credit Access, Arman, they have 70 to 90% in this space, and they're pretty well placed. Do you like any of these two?
So see, microfinance is always cyclical. No matter what anyone tells you, there is a good cycle, there's a bad cycle. Right now, we are going through the deepest point of the bad cycle. Maybe in a quarter or two, from the deepest point, we'll start the upward journey. So if somebody is interested in playing cyclical stocks, I think this sector offers upsides. The best companies, the best managements are Credit Access and Arman in this space. But, we feel that microfinance, even in the upside, it will be a little slow because that over leveraging was just too much. So in this space, we like something else, which is Northern Arc.
But tell us more about this Northern Arc, because there was a pending large trade. It took place, got cleared out around 200 rupees. From there, that has been one of the biggest outperformers from the broader markets. So at around 260 ballpark, what's your view on this name?
Okay, so...
And what are the key triggers you'll be tracking on this one?
Perfect. So see, Northern Arc is a very unique company. They lend to 300 other NBFCs. That is their first business. Second business is they lend to small LAP, microfinance, just like, a lot of other companies, say SBFC or, 5-star would do. So they have these two major businesses. One of the business, which is microfinance, had some trouble, and which is why the stock is trading at 1.1, 1.2 times book. I think the base business is so strong that once the microfinance down cycle is over and the up cycle starts, this will also re-rate quite significantly. So in Northern Arc, I see that there is a reasonable room, just like JM Financial or FedFina, there is a reasonable room for the business model to outperform in terms of earnings. So that is our business case in Northern Arc.
Northern Arc and JM Financial. But before we wind down, we had a couple of stocks on the screen, SBFC and 5-star business. They traded around 4 times approximately. What's your view on these two names, or are you going to give us an alternate?
See, I think both are into that very high lending space and they're growing fast. So this is an area which I try to become a little cautious, that high yield and fast growth. There's a chance of mistakes. Valuations are also very rich, so there is no margin of safety. So I think gold loan companies in this environment, investors are better off being in gold loan companies than in these companies. Maybe once the environment improves, we can do a shift trade. But
all right, Digant, it's been a pleasure having you on the show. Thanks a lot for joining in, explaining all of that to us. Just to rewind, India Shelter, something that you like. From the gold finance companies, FedFina, something that you like. And from the other stocks, Northern Arc, JM Financial, they could still look from here on. And that trade you spoke about, maybe it's time for Chola to make way for HDB Financial. It's been a pleasure having you on the show, Digant. We look forward to chatting up with you soon.
I'll just say one thing, that investors need to be patient. This whole cycle, it will take 2 or 3 quarters for the cycle to really turn around. And yeah, be long-term, track the businesses, not the stock price. And whatever we spoke is business analysis. That's it from my side.
Well,
thank you for having me.
Bang on, Digant. On that note, though, we'll wind up on this edition of Finding Alpha. Thanks a lot for joining in. We hope we managed to dissect the entire space for you. More news and updates coming up on the other side.
Hello and welcome to News Center. I'm Parikshit Dutra. With only 4 days to go before US's August 1st deadline to impose tariffs, trade talks between New Delhi and Washington are in a stalemate. Sources tell CNBC-TV18 that there is no major breakthrough as US is seeking a more ambitious agreement with India. The United States wants zero-duty access to the Indian markets like America's deals with Vietnam and Indonesia. The Trump administration is also pushing for India to commit to big-ticket purchases and investments. Meanwhile, India is evaluating its options ahead of the deadline. The options include the imposition of equal reciprocal tariffs. Remember, US Commerce Secretary Howard Lutnick has said that Washington's August 1st deadline will not be extended. Both nations plan to agree on a bilateral trade agreement by October. A delegation from the US is expected to visit India in August for the 6th round of talks. To take this discussion ahead, I'm now joined by Jayant Dasgupta, former Indian ambassador to the WTO, and Sudhir Sekhri, chairman of the Apparel Export Promotion Council. Also on the program with us, Ajay Sehai, Director General and CEO of the Federation of Indian Export Organizations. Gentlemen, thank you very much for joining us. Ambassador Dasgupta, to begin with you, do you think India now, in the absence of any kind of interim deal, will have to be ready, prepared for an eventuality where there may not just be 26% reciprocal tariffs, but plus a 10% additional BRICS tariff as well?
Of course, we are keeping our fingers crossed as to whether there would be an agreement before the 1st of August deadline. But failing that, India could expect something in the region of 20-25% perhaps as tariffs, because Indonesia has got 19%, Vietnam 20%, Japan and Korea 25%. So I think that is, and of course the Europeans seem to have got 15%. Of course, the agreements, details of the agreements with Japan, EU, Indonesia, none of them have come out. And it is also not very clear whether the full written text is available at all with either side. So there is a lot of uncertainty, but I think the tariffs, if they are imposed by President Trump, will be perhaps, hopefully, in the region of 20% or so. Now, the other thing is that India is negotiating not only against this deadline of the 1st of August, but the first tranche, which is supposed to be ready by about October, and which will cover a very wide-ranging array of subjects on trade. So President Trump, while taking a decision, would definitely bear that in mind, that even if there is no agreement in the interim, the first tranche could be negotiated, and steps have been taken in that direction.
Right. So let's see how exporters and companies in India are preparing despite all this uncertainty. Mr. Sekhri, to get you in, how is this impacting your businesses, your exports to the United States? In the eventuality there is a 25% or a 26% tariff, how is the business going to be impacted?
Well, you see, we have to see it in the context of what is going to happen with our competition. Our business today is definitely at a standstill because the buyers are not clear as to what the tariff is going to be. So they're holding back on orders. I'm talking about the US buyers. Our business Europe is also impacted because of the high tariffs that the US has imposed on China. A lot of Chinese manufacturers are now selling to Europe at very low prices. So that's where a lot of European orders are also moving to China. Now, coming back to the US context, yes, we definitely look forward to a very fair and equitable tariff for India. And what we have been given to understand by government sources is whatever best the government could offer has been offered to them, and we cannot do anything better than what we've done. So given this scenario, we are keeping our fingers crossed, like the ambassador just said. But we believe, based on sources, that it could be anything from 15 to 26%.